which was received. And this premium can be received either from the clients, from the insurance brokers, from the insurance brokers. Then on this side, still we have the reinsurance premiums which were received, reinsurance premiums which were received. On this side, we have the reinsurance premiums which were paid, reinsurance premiums which were paid. So this is basically whereby I hope you know what is basically to reinsure. So assuming we have a certain insurance company A, this insurance company A, which has got a number of clients, and this particular client have insured a number of subject matter with it, but this insurance company may feel that the risk insured with it are too much. If maybe something happened, it may not be able to pay. So this insurance company may make a decision, can we reinsure some of this risk with another insurance company? So insurance company B, maybe something like that. So this insurance company will be paying something called the insurance premium. And then this one can receive reinsurance premium from another insurance company. So this reinsurance premium paid, the double entry, we debit this account, we credit back. And then from there, what we do, we basically balance this account. The balancing figure, which is on this side, is the net claims. The net claims. And the net claims is basically now what we recognize there. So that's basically how we compute the net premium, So then the other note we need to discuss here is on this one. The commission on reinsurance ceded. Commission on reinsurance ceded. Commission on reinsurance ceded. Commission on reinsurance. Oh, sorry. Sorry. This one should be net premium, not net claim. Thank you, Mike. Yes, so that one should be the net premium, not the net claims, Thank you for that. Yes. Now, in this case here, what is the commission on reinsurance ceded? So first of all, to cede ground is basically whereby you accept that as an insurance company, the risk insured with you are too much. If all the claims are raised by your customers, you'll not be able to pay them. So you have ceded the ground. So therefore, what you do, you reinsure those particular sum of the risk with another insurance company. So assuming we have insurance company A, this company may feel that the risk insured with it are too much. So it decides to do what? To reinsure some of them with the insurance company B. It is obvious that this company here will pay something called the reinsurance premium. So this company A, will pay something called the reinsurance premium. So this particular reinsurance premium, we said to the insurance company A, they are reinsurance premiums which have been paid. It is obvious that this company here, that is insurance company A, is giving insurance company B some insurance business. It's then fair for this company to pay some commission. So if I give you some business, some insurance business, you must give something in return, which is called a commission. So therefore, the commission which will be paid by this insurance company, and basically which is paid to our insurance company A, to this company we say it is a commission on reinsurance ceded. It's the commission on reinsurance ceded. To this insurance company is an income. Is an income. So therefore, we can say this number one is an income. And number two, we can say it is computed. It is computed based on the reinsurance premiums which are paid. So the reason why it is important for you to note that is because in most of these particular questions, you'll be told that the commission on reinsurance ceded is 5%. 5% of which the examiner will not tell you. 5% of the reinsurance premiums which were paid. So if this company paid reinsurance premium of 2 million, there may be an agreement that this company will be paying a commission of 2%. So it should be 2% of the reinsurance premiums which were paid. Yes. So then from there, we can look on the other item here, the net claims. How do we compute the net claims? So the net claims Basically, these ones are computed by preparing the claims account, the claims account, the net claims, the net claims. So in this case, we have to prepare the claims account. So remember, claims, this is what now the customers, the clients of the insurance company want to be paid. Want to be what? To be paid. You have insured a certain subject matter, and maybe because the event insured against has occurred, you have reached a claim with the insurance company. So this one we have said to an insurance company is basically what? Is an expense. So equally in this case, we prepare this for each insurance business, assuming we have fire and we have rise. We have fire and we have rise. So in most of the cases, we'll be told, number one, there were some premiums, not premiums, sorry. There were some claims which were not yet paid by the insurance company. So the premiums not yet paid by the insurance company, this is the liability. So being a liability, the claims outstanding being a liability, that one would be the opening balance with this account on the which side? On the credit side. So the claims outstanding at the start, the claims outstanding at the end. At the end. What else do we record in this particular account here? The other item which we record here are basically the claims which were paid. You'll also be given the claims which were paid. The claims which were paid. So the claims which were paid, basically the double entry for that is what? The double entry for that would be to debit this account with credit bank. With credit bank. That is basically the double entry for that. Then the other item you may be given is what? Are the expenses relating to the claims. Expenses relating to the claims. Expenses which relate to the claims. And basically the expenses relating to the claims, those ones, they should be So these are questions on compound financial instruments, which basically falls under the topic of financial instrument, CFI. CFI in full is what? The compound financial instrument. Now, maybe just a quick recap, even before you go on that question. We say that compound financial instrument, basically, these are the financial instruments which contains both the equity and liability component. And actually, we said good examples of these are the convertible securities. Convertible securities issued by the company, like the convertible debentures, the convertible bonds, the convertible own stock, and so on. All those are good examples of compound financial instruments. So therefore, these financial instruments, we say they contain the liability, and also the equity component. The equity component. We have said good examples of this. Examples of this include something like the convertible debentures. The convertible debentures. And therefore, what we say is that once you come across a question from this topic, and specifically you're told a company has issued a compound financial instrument, like the convertible debentures, the convertible bonds, and so on, the first thing you need to remember very fast is that that is what? A compound financial instrument. Why do we say that these financial instruments which are convertible, they contain liability and the equity component? Number one, we say they contain the liability component simply because the issuer, the company which issued these convertible debentures, has an obligation. The issuer has an obligation to pay cash. Has an obligation to pay cash, and the cash to be paid here is in form of interest and also in form of what? A principal amount. Like in this case, we say, if, for example, company X has issued convertible debentures, this company has to pay the interest on annual basis, and once these particular debentures mature, the company has to redeem them in terms of paying back the principal amount. So therefore, we say that this obligation to pay cash in form of interest, in form of principal amount, that obligation is basically a liability. Is what? A liability, because we know from definition, liability is an obligation to pay. Is an obligation to pay cash. On the other hand, we say that these convertible securities contain the equity component simply because the holder basically has a right. The holder has a right to convert them into the ordinary shares. To convert them into ordinary shares. In other terms, what that means is that once you have invested in convertible debentures, you have a right to convert them into ordinary shares. That right which you have to receive the ordinary shares of the company, that is called an equity. That's why we say any convertible security basically contains the liability and the equity component. Basically, what we say is that once a company has issued this compound financial instrument, the two components, the liability and the equity component, should be splitted. So we talked about two steps to be followed here. Step number one, we said we compute the liability component. How do we compute this one? We compute this by discounting two items, by getting the present value of two items. The present value of the annual interest to be paid and the present value of the principal amount. So that gives us the liability component. Step two, we proceed and we compute what? The equity component. So the equity component, we say that this is equal to the difference between the sales proceed. Sales proceed basically the amount of money which the company received after issuing those compound financial instruments minus the present value of, or actually minus the what? Minus the value of the liability component. The value of the liability what? Component. So therefore, that's basically how we split the two parts, the liability component and the equity component. So let's just go straight to that particular question. We will be able to understand more how we do the split, how we split the two components, the equity component and basically the liability component. I've already shared that question, that small question which I want us to do in the class WhatsApp group there. In the class WhatsApp group. So what are we required, or what are we told here? So the question reads, a good limited issued shillings 4,007,000 convertible bonds on 1st of January 2019 at par value. So the bond is redeemable at par on 31st of December 2023 or can be converted at that date on the basis of 2 shillings 1 ordinary shares for every shilling 10 of the bonds held. And then you're told the prevailing market interest rate on 1st January 2019 for similar bonds without conversion rates was 9% per annum. And then you're told all the interest due in the year which ended 31st of December 2019 have been paid. So what we are required to do basically is we compute the amount to be included in the statement of financial position for Good Limited in respect of the convertible bonds on 31st of December 2019. I think what you're going to do, we will change that particular requirement, and basically what we will do, we will prepare the financial statement extract of this company basically for how many years? For I think 4 years, because these bonds they have right for 4 years. I think 4 years. We have the first year which ended 2020, 2021, 2023. So they have a life of 3 years, because if you check in paragraph 1, sentence 2, they will be redeemed at the end of 2023. They were issued on 1st January 2019. So basically they have a life of 3 years. So what we will do, we will prepare financial statement extract for how many years? For 3 years. So now say this is a question from the paper for financial statement analysis. This is a paper which is basically done in CIFA. And specifically, this was a question from the sitting of November 2020. Question number 5A. Question 5A. So the first thing, and maybe we can even mention here before we proceed to prepare financial statement extract, is that these convertible bonds which were issued by our company, this is a compound financial instrument. It's a compound financial instrument. So we can say that the 7% convertible bonds issued by Good Limited, is a compound financial instrument, is a CFI. It basically contains both equity and liability component. Therefore, what we say is that once a company has issued such a compound financial instrument, on the date of the issue, the company should split the two components, the liability component and the equity component. So we need to follow the 2 steps. So we need to start by computing the liability component, because we say that is step 1. We compute the liability component. So this liability component is basically computed on the date of the issue, or actually we do the split on the date of the issue. That's when we do the split. So if you check on the date these bonds were issued, they were issued on 1st of January 2019. 1st January 2019. That is the date we need to compute the liability component and the equity component. So how do we compute this one? This one is equal to the present value of the annual interest plus the present value of the principal amount. The principal amount is the amount to be paid on redemption. So let's start by computing this one, the interest to be paid annually, the interest per annum. And we say this one is computed by taking the coupon rate. We say these formulas are very, very important. The coupon rate times the par value. The par value can also be known as the nominal value. Can also be known as the face value of this compound financial instrument. And in this case, we said that always in these questions will be given 2 rates. Like if you check, we have this rate of 7%, this one. And then in paragraph 2, we have another rate of 9%. So we say this rate, which are given before the name of the compound financial instrument, this one is the one, this is the coupon interest rate, So therefore, the interest will be paid annually and will be based on the coupon rate. This is the coupon rate, 7%. And then you multiply that with the par, the nominal or the face value. That is given within paragraph 1, because we are told Good Limited issued shillings 4 million, 7% bonds on 1st January 2019 at par. So the company issued bonds which had a value of 4 million, and you're told that 4 million is the par value. The par value, I've said, can also be known as the nominal or the face value. So this will give us the interest per annum. The interest per annum. So the interest per annum here will be shillings 280,000. So this is what the company will be expected to pay per annum. And then from there, we can proceed and basically we determine what will be the principal amount. The principal amount in this case we said is the amount payable on redemption. Amount payable on what? On redemption. And in this case, I say the amount to be paid on redemption is always equal to the par value unless sold otherwise. So we say that this one is equal to the par value, or basically the nominal or the face value, unless sold otherwise. Unless stated what? Otherwise. Unless stated otherwise. Unless stated otherwise. So I think there is some information which is given in relation to this within paragraph 1, sentence 2. So we are told the bond is redeemable at par. The bond is redeemable at par. So the par value of the bond is what? Is 4 million. So when the company is redeeming them, the amount to be paid will be how much? Will be 4 million. Will be 4 million. So having those two values, the annual interest and the principal amount, we need to discount them, and we get the liability component on the date of the issue. So in this case, we can just have a procedure here for discounting this. So remember, they were issued on 1st January 2019. When will they be redeemed? They will be redeemed at the end of 2023. So how many years do we have between those two dates? 1st January 2019, 31st of December 2023. How many years do we have here? The first year will end 31st of December 2019, actually, 2019, the other one 2020, the other one 2021, 2023. Are those 4 years? They are 5, eh? Yes, because we have 2019, 2020, 2021, 2022, 2023. 1, 2, 3, 4, 5. Yes. So basically there are 5 years. Are they 5 years? Please? Are they 5 years? Diana, Georgina, are you getting 5 years? 2019, 2020, 2021, 2022, 2025. Yes, we have 5 years. So meaning that we will have 5 years here. Year 1, year 2, year 3, year 4, year what? Year 5. And then here we can have the cash flows. Basically, cash flows is what our company will pay. We can just refer to them as cash flows. So in the first year, remember, at the end of each year here, our company will be paying interest of 280,000. 280,000. 280,000. 280,000. But now at the end of year 5 here, the company will pay 280, plus the company will have to redeem them by paying back 4 million. That's basically what you need to know. That's what you need to know. Yes. So here we will have 280,000, 280, 280,000, 280, 280, and then in the last year here we will have 280 plus 4 million, which will give us 4 million and 280,000 and 280,000. And then what we need to do is to discount this by multiplying that with the present value interest factor. And actually we say here we use the effective interest rate. For discounting, we use the effective interest rate. The effective interest rate is what we have within paragraph 2. The effective interest rate is what? In paragraph 2, 9%. That is basically the rate which you use for discounting, 9%. 9%. And then we will get the present what? The present value. So first of all, give me those values there. The present value interest factor. So remember here, which formula do we use? We use this 1 plus R raised to power negative N raised to power negative 1. So it should be 1.1 in year 1. You raise that to -1. In year 2 is 1.1 raised to power -2. In year 3, 1.1 raised to power -3, and so on up to the last year. So in the last year we have 0.9174. Yes, year 2, what do we have? Year 2, year 2, year 2, what do we get in year 2? You try to hurry up because of time. Yes, what are you getting in year 2? Yes, alternatively, you can use PV, but basically, remember I say that there are different approaches of discounting this. There are different approaches of discounting this. If you feel that this one is quite wrong, let's first of all finish this one, and then I show you another approach. I show you another approach of doing it. Another approach of doing it. So I'm waiting for this present value interest factors. For year 2, it will be 1.1. Yes, year 2 is 0.84, 84.17, 77.22. Year 4, 70, 84. And year 5, what do we get here? 64, 99. Yes, so then you take these values, you multiply them, you get these present values, and then you give me the total here. Just give me the total there. Just give me the total. Just give me the total. So you can do that. Alternative release is asking, can we use another approach? Yes, there is still another approach because now these 280 are annuities. Are annuities, you can just take 280 times PVIVA. PVIVA, the present value interest factor of annuity, at the rate of 9%, at the rate of 9%, and basically for 5 years. For 5 years. So you compute this, then you add the present value of this, 4 million. You take 4 million, you multiply that with the present value interest factor. This is not an annuity at the rate of 9%, basically at the end of 5 years. You can still use that approach. You can still use that approach. You'll get the same value by the end of the day. You'll get the same value, the same value by the end of the day. So you can use either of the approach. The one maybe you feel is simple for you. So you can use either of the approach. Yes. So now what do we have here? What do we have here? So whatever we have computed here is the liability component on this date. The liability component. This is the liability component. The liability component on 1st January 2019. That is the liability component. So having computed the liability component, step 2, we need to proceed and we compute the equity component. The equity component still on 1st January 2019. How do we compute this equity component? We take the sales proceed. The sales proceed is basically the amount which was received by the company from the issue. Once the company issued these 7% convertible bonds, how much amount was received? Now, in paragraph 1, we are told they were issued at par. They were issued at par of 1 million. Not 1 million, they were issued at par of how much? Of 4 million. So this is the amount which was received. The amount which was received by the company was 4 million. So to this, we less the liability component on the same date. We less the liability component still on that date, 1st January 2019, which we have computed here, that is 36, 88, 828. So the difference here will be the equity component on 1st of January 2019. And this should give us 100 and something. Oh, sorry, not 100. Not 100. That is the 300, 172, 172. So that is basically the what? That is the equity component, the equity component. Now, basically what we said is that this equity component, the value for the equity component, this one does not change. Over the 5 years, this one will not do what? This one will not change. But this one we have to amortize it. So what I want us to do, I want us first of all, we amortize this so that then we can proceed and we prepare financial statements extra. So let's amortize our liability component. And we amortize this one by preparing the amortization schedule. By preparing the amortization schedule. So here we need to have 5 years. Year 1, year 2, year 3, 4, 5. Remember, this is a year now which either 2019, 2020, 2021, 2022, 2023. And then the next column here will be the liability at the start of the year. The liability at the start of the year. The next column here will be for the interest. And remember, this now will be an interest expense. So because our company has issued the bond, so this one will be recognized in the income statement as an expense. Now, this one, you also have to recall, we computed based on the effective interest rate, not the coupon rate. We compute this based on the effective interest rate, which is basically 9%. And then we have a column here for the cash to be paid by our company. And finally, the liability at the end of the year. The liability at the end of the year. So those are basically the columns we should have here. So what we start with here is the liability at the start of the year 1. Liability at the start of year 1, what we have computed here, because this is the amount we want to amortize. To amortize, we said, is to gradually write off the liability. So at the end of year 5, the value for this liability should be 0 because it represents, or this liability represents what the company will pay for the next 5 years. At the end of the 5th year, the value for that liability should be 0. So it is basically 36, 88, 828. So we compute the interest, which will be 9% of this. The interest, which will be 9% of that, which will be 331, 995, 995. That is the interest expense. Then we already have the cash to be paid. The cash to be paid is what we have here. This is what our company will pay for the next 5 years. So in fact, we can have those figures here to 80,000, then to 80,000. Year 3, the company still will pay to 80,000. Year 4, the company will pay to 80,000. And year 5, the company will pay 4,280,000. That is basically the cash to be paid. And this cash to be paid will basically reduce the liability. So meaning, to compute the liability at the end of the year, we take the liability at the start plus interest minus what was paid. So we get the liability at the end of each year. So the liability at the end of year 1 will be what? This plus this minus 280. Minus 280, which will give us 740, 823. 823. So how have we computed that? The liability at the start plus interest minus what was paid. Now, the liability at the end of year 1 will be the opening balance here, which is 740, 823. So what we need to do is basically proceed and compute what? We compute the interest. So what will be the interest? 9% of this. 9% of that, I'm told, is 336. As 336, 674. And then you compute the liability at the end of year 2, which will be equal to this plus this minus that. That will give us 37, 97, 497. 497. That will be the opening balance here. That is 797, 497. So how much interest will be paid in year 3? How much interest? 341. 341,775. Yes, and the liability now at the end of that year, the liability, the liability will be 38,59,272. Yes, so that will be the opening balance at the start of year 4, 38,59,272. What about the interest? The interest I'm told 347, 347, 3 what? 337, 337. The liability at the end of that year, the liability at the end of that year, the liability 3926, 3926, 606. Yes, that will be the opening balance here, 3926, 606, and the interest 353, 353, 395, 395, and then we compute the liability at the end of year 5. The liability at the end of year 5, this one should be 0, but you may get a figure which is insignificant. I'm told the figure there is 1, but essentially that one should be 0. The reason why we are getting 1 is because of the aspect of what? Rounding off. Now, having that, what then do we need to do? We need to prepare the financial statement extract, because we say mostly the question will come across at your level is whether you're required to prepare financial statement extract. You show what was supposed to be accounted for in the income statement, or what was supposed to be recognized in the income statement, as far as these compound financial instruments are concerned, and what was supposed to be recognized in what? The statement of financial position. So let's start by preparing the statement of profit or loss. Profit or loss. Remember, this is basically an extract. An extract, we say, is part of something, is part of the statement of profit or loss. We are preparing this for 5 years. Remember, now we can have the specific dates. The first year ended 31st of December, 2019. The other one, 31st of December, 2020. The other one, 31st of December, 2021. 31st of December, 2022. 31st of December, 2023. 2023. Now, what was supposed to be recognized in the income statement of this company? Just one item. This particular interest expense will be recognized here as what? As an expense. Was supposed to be recognized here as an expense. Other expenses. So this interest expense should be recognized there. In other terms, you can just say that this one will be a finance cost. Will be a finance cost, because that one will be included within what? The finance cost. So the finance cost for the first year is 331,995. Year 2, 336, 674. That is year 2. Year 3, 341, 775, 775. Year 4, 347, 337. And year 5, 353, 395, 395. So this is what was supposed to be recognized in the income statement of this company. What about the statement of financial position? In the statement of financial position, we say 2 items. One, we have the liability component, this one, which should be recognized as a liability here. And then number 2, we have the equity component. The equity component. So this is a statement of financial position extract. So basically, we equally need to prepare this for how many years? For 5 years. 2020, 31st of December 2021, 31st of December 2022, 31st of December 2023. 2023. So 2 items to be recognized here. One, under equity, our company will recognize this particular component here, the equity component. And you have said that the value for this equity component will not change over the period of 5 years. So under the equity, the company will have something called the equity component. Equity component of what? Equity component of 10% convertible bonds. Over 10% convertible bonds. Of 10% convertible bonds. So that will be 311, 172, and actually that will not change over the period of 5 years. 311, 172, 311, 172, 172. And then under the liabilities, or basically under the non-current liabilities, under the non-current liabilities, non-current liabilities. So the company will recognize something called the liability component, a component of, was this 10% or 7? I think this one was 7%. 7%. 7%. Yes, 7 over convertible bonds. 7% convertible bonds. So the liability component at the end of year 1 is what we have here, this value here. That is 3740, 823. Then 2020, this one, 37, 97 for what? For 97, year 3, we have 3859 to 72. And then here we have 3926, 606, and then there is what? Is 0. There is 0. There is what? Is 0. Is 0. Is 0. Yes. So that is it. That basically what was required there. That what was required there. Yes, so therefore, if you happen to come across such a question on a CFI compound financial instrument, I think that what you need to remember that the two components, the liability and the equity component, must be splitted, and then the liability component to be amortized. But you have seen that the value for the equity component remain the same, remain the same. Yes, so that is it. I'm trying to look for a different question, maybe. Why haven't we calculated the value for the liability, for the current liability? So I think in case of a financial instrument, we don't do that like what we are doing under leases. I think I'd mentioned that when we were working on this. So this liability component, we don't have to split it like what we are doing under leases. So remember under leases, this liability, we were splitting it as non-current and also current. But in this case, that is not a requirement. That is not a requirement under this standard. Under this what? Standard there. Sasa, yes. Now, there is a question which is here, but basically similar to a question which was, I think I'd given you this question as an assignment. It was a question from a PAL. but I hope we never did that question in class. And we do that question, or we can just get another one, because this one is basically similar to what we did in class. So we don't have so many questions on basis. Remember, this is a new standard. This is a new standard. IFRS 16 is basically a new standard. So we don't have so many questions which have been tested in accordance with the IFRS 16. IFRS 16, we don't have so many questions on this, because I think we were able to do all the questions from your past papers on ERISIS. Maybe what I'll do, I'll just get a question for just revision. Let's just use this question from a part, although even if it is similar to the other which we did in class. So let me share this in the class without group. Let me share that in the class without group. Yes, so check the question which I've shared here in the class without group. So if you see it, please confirm. Have you seen the question? Okay. Recess. Remember, we say that this is currently are accounted for in accordance with IFRS 16. Previously, recess were accounted for in accordance with the International Accounting Standard number 17. But basically, we said that standard was corrupt. Currently, recess should be accounted for in accordance with International Financial Reporting Standard number number 16. And actually, we said, as per that particular standard, whenever the owner of the asset basically leases out an asset which he owns, the first thing he needs to do, even before he proceeds to account for this, is to determine whether the risk is a finance or an operating risk. So we said, for the accounting purpose, the owner of the asset, who is also called the lessor, should classify the risk as a finance or operating risk. And we're able to look on how the operating risks are accounted for, and also the finance risks are accounted for. But now the person who has been given the right to use the asset, who is called the lessee, we said he should not do what? He should not classify the risk as a finance or an operating risk. That classification of the risk as operating or finance is only applied to the lessor, the owner of the asset. Now, what we say the lessee should do is to recognize two items: the risk liability, the right of use asset. If you lease an asset, recognize two items: the risk liability, the right of two assets. But also recall, we talked about two exemptions whereby the lessee, or actually we talked about two circumstances whereby the lessee is exempted from recognizing those two items. You can lease an asset, but basically you're not required to recognize a risk liability and the right of use what? Asset. Which are those two circumstances, or which are those two instances? One is whereby you have leased an asset which is regarded to be of low value. You have leased an asset which is regarded to be of low value, like maybe a personal computer or maybe an old car. Number two is whereby you lease an asset for a short period of time, or basically you lease an asset under the arrangement of a short-term lease. A short-term lease. A short-term lease is basically a lease whose lease term is 1 year or less. 1 year or good or less. Okay, so let's look on that question. And basically, this is a question from the paper for a 𝐻𝐿-CP intermediate level. Specifically, the question for what? For August. We will do that question a little bit fast because it is basically similar to another question which we did in your paper for a 𝐻𝐿, but let's just do it as part of our revision. So what are we told? We are told on 1st January 2019, Breakwood Limited entered into a contract to lease. So we did this one. Okay, if we did it, no need of repeating it. Do we need to repeat it? So if we did this one, do we need to repeat that? I don't think so. I don't think so. I don't think there is need of repeating it. I don't think there is need of repeating it. No need, no need. No need. Okay. Then we do this. We take a short break of 5 minutes. I've tried to get another question and share it with you, and then we do it after break. So let's just do, we take a short break of 5 minutes. We come back. Yes, so I think we can proceed. Let's continue. So there is, I've shared 2 questions with you here. There is a question on sales leaseback, and also another question on, I think, accounting for leases. So I want us to do that one for sales leaseback. Let's do the question for sales leaseback. I think that is maybe the concept which was a little bit technical. And I hope you can see that question. Hopefully it's not similar to the other one we did. Is this one similar to the other question we did in class? I hope not. I hope it is not similar to the other question we did in class. Yes, it is not. It is not. It is not. So let's go to that question for the sales with leaseback. The question for Wingstone Limited. Wingstone Limited. Are you there? Wingstone Limited. Wingstone Limited. If you are there, please confirm. Wingstone Limited. Wingstone Limited. So this is a question which was examined in November 2018 from the paper for FSA, Financial Statement Analysis. This is the CIFA. Specifically, this is a question number 3, C. Question 3C. So it's a question on sales leaseback. Remember, I said a sales leaseback. Just a quick recap. We said that this whereby the owner of the asset basically sell that asset, or a company sell an asset and immediately lease back the asset. So meaning that the company which owns the asset and basically selling that asset, that company is called the seller, and basically sell that particular asset to another company which would be known as the buyer. But after the asset is sold, we say that this company here will basically lease back the asset immediately. So we have a sale here of the asset being sold, and then we have a lease. We have a lease contract. So, and because this company has bought the asset, meaning that it is the owner of the asset, it is the one which is leasing out that asset. This company is also known as the lessor. So therefore, we say the first party in a sales leaseback transaction is the buyer lessor. Is the buyer lessor. And then this company here, because it has leased back the asset, this company is also known as the lessee. So therefore, in a sales leaseback transaction, we say that we have 2 parties. We have the buyer lessor, and also we have the seller lessee. Now, what is said for us to be able to account for this particular transaction here, or this sales leaseback transaction, we basically need to determine whether this sale here basically amount to a true sale. So whether this sale is a true sale, or basically whether this amount to a true sale or not. And actually, we said that this will amount to be a true sale if basically it satisfies the requirement of IFRS 15. So this transaction shall be deemed to be a true sale if it satisfies the requirement of IFRS 15. Basically, we say it will be this transaction will be a true sale if the control of the asset is basically transferred to this party. And number two, the rewards and also the risk associated with the asset are transferred to who? To the buyer. But if you check on that particular question there, I think in the last paragraph, we are told the transaction satisfies the requirement of IFRS 15, the revenue from contract with customer. So basically what that means is that this is a true sale. Is a true sale. So we say if then the transaction is a true sale, what happens is that this party here, the seller resaw, the seller receive, not resaw, the seller receive. Number one, we need to recognize the asset. He need to recognize the asset. So to recognize the asset, he need to remove that asset from his books of account. He need to recognize that asset. Number two, he need to recognize something called the profit or loss on sale. The profit or loss on what? On sale. And I think we looked on how we compute that. This party also here will need to recognize something called the right of use asset because he's leasing back that particular what? Asset. And number four, he also need to recognize something called the lease liability. That's basically what we say. So if the transaction amount to a true sale, this party should recognize the asset, recognize the profit or loss on the sale, recognize the right of use asset, and recognize the right, there is what? Liability. And actually, we said what you need to remember here is specifically how we compute these two items. How do we compute the profit or the gain or loss on sale? And how do we compute the right of use asset? There are two formulas which I gave you, which we agree that you must be able to remember those two formulas. In terms of how we compute this one, the lease liability, we say this one is quite simple. This one is always equal to the present value of the lease payment. The present value of the lease what? Payment. So, but how do we compute this one? First of all, the right of use asset. Can you be able to remember that formula of computing the right of use asset? We said we take what? We take the previous carrying amount, or basically the net book value of the asset, and then you multiply this with what? You can be able to remember that very fast. We multiply this with what? The previous carrying amount of the net book value of the asset times what? Times what? Times what? Who can be able to remember this phase? Gilbert. Yes, times what? The present value of the lease payment all over the fair value of the asset. The fair value of the asset, we said, is the same with the sales what? Proceeds. Is the same with the sales what? Proceeds. What about this one? How do we compute this one? The profit or the loss on a sale. So we said we compute the normal gain or basically loss. The normal gain or loss, this one is computed by taking the sales proceeds minus the net book value or the carrying amount of the asset. And basically we multiply this with what? Who can be able to remember? We multiply this with what? We multiply that with what? The normal gain or the normal loss. We multiply that with what? Yes, we multiply this with what? With basically here the denominator should be the fair value or the sales profit, just like here. And then we also take here the fair value minus the present value of the lease payment. Those are the two formulas which we say that very important as far as the sales leaseback transaction is concerned. So if you can be able to remember that, then the question becomes simple. And then we say, if this transaction is a true sale, now the buyer SO will actually account for that particular transaction, or actually will account for that lease as either operating or finance. So let's go to this question and see what we are told. So we are told that Winston Limited bought a drilling machine for shilling 7.2. That is the cost, 7.2 million on 1st April 2016. The machine had an estimated economic useful life of 6 years on that date, and a straight line depreciation to a nil residue value was provided. And then you're told on 1st of April 2017, Winston Limited sold the machine to Whiteside Limited for shillings 8.88 million at its fair value. That is basically the selling price or the fair value. And then you're told 𝐕𝐎𝐻 Limited immediately leased back the machine from 𝐻𝐻 Limited for 5 years, the remainder of its useful life at rental of 1.92 million per annum, payable in arrears. The present value of the annual lease rentals at the inception date of the lease back amounted to 8.4 million at the implicit interest rate of 4.625%. The transaction satisfies IFRS 15 revenue from contract with customers. So what are we required to do here? Roman 1, we're required to compute the amount of gain that 𝐕𝐎𝐻 Limited should recognize for the year which ended 31st of March 2018 in respect of the sales leaseback. Roman 2, we're required to prepare extract of financial statements of 𝐕𝐎𝐻 Limited for the year which ended 31st of March 2018 to account for the right of use asset and there is liability. And there is what? Liability. A very good question on sales leaseback. Sales leaseback. So what we are told is that the company which is called 𝐕𝐎𝐻 Limited. So this particular company bought a machine at 7.2 on 1st April 2016. And then let's go to paragraph 2. In paragraph 2, you're told on 1st of April 2017, 𝐕𝐎𝐻 Limited sold the machine. So this company is the owner. It sold the machine to the company which is called 𝐻𝐻 Limited for 8.88 million. And then in the other paragraph, you're told 𝐕𝐻 Limited immediately leased back the machine from 𝐻𝐻. It basically means that this company here, this will be the buyer, not buyer, sorry. This company will be the seller, lessee. So this company sold the machine and immediately leased back the machine. This company here will be the buyer, lessor. Will be the buyer what? Lessor. And now what we are told is that this transaction basically satisfies the requirement of IFRS 15. So it basically means that this transaction is a true sale. This transaction is what? Is a true sale. Is a true what? A sale is a true sale simply because it satisfies the requirements of IFRS, the right of use asset, and there is what? Liability. So what we are required in Roman 1 of the question is we compute the amount of gain, to be recognized by who? To be recognized by 𝐕𝐎𝐻. To be recognized by 𝐕𝐎𝐻 Limited. To be recognized by 𝐕𝐎𝐻 Limited. 𝐕𝐎𝐻 Limited. Remember, 𝐕𝐎𝐻 Limited is the seller, lessee. Is the seller, lessee. So you just need to remember that formula which we had up here. So how do we compute this gain or the loss on disposal to be recognized? So the gain, or basically the loss on sale, or basically the disposal, to be recognized, we have said is equal to the normal gain stroke loss. But automatically in our case here, we will have a gain. We will have a gain, and then we multiply this with what? With the, we have said we multiply this with what? With the present value of the lease payment, the present value of the lease payment. Okay. Is it the present value? No. This one should be the fair value. The fair value of basically the sales profit minus the present value of the lease what? Of the lease payment, divided that with the fair value or the sales what? The sales profit. The sales what? The sales profit. The sales proceeds. So that's basically what you need to remember here. So we need to compute the normal gain or loss. The normal gain or loss, this one is equal to the sales profit. The asset was sold at how much? Minus the net book value, or basically what? The carrying amount. I think there is something which you're not given here, the net book value of that asset. We're not given the net book value or the carrying amount. We need to compute this. How do we compute the net book value? Or how do we compute the carrying amount of an asset? So this one is computed by taking the cost of the asset minus the accumulated depreciation. We're going to use the information within paragraph 1. The information within paragraph 1, because we are told that this machine was bought by our company, that is Winston Limited, at 7.2 million. 7.2 million. That is a cost. That is a cost. We less the accumulated depreciation. So the accumulated depreciation, we are told it was bought on 1st April of 2016. So it is important for you to note that we are computing this net book value at the time the machine was sold. So when was the machine sold? As per paragraph 2, the machine was sold on 1st of April 2017. This is when the sale took place. But when was it bought? It was bought as per paragraph 1 on 1st of April 2016. So mean that this machine just was used for 1 year. Was used for 1 year. So therefore, we need to compute depreciation for 1 year, which will be equal to the cost. Remember, we are told in paragraph 1, sentence 2, the machine had estimated economic useful life for 6 years. A straight chain method is to be used, and a nil residual value. So the depreciation per annum will be equal to the cost minus the scrap value, which is 0. We divide that with what? With 6. So that will give us depreciation for 1 year. Depreciation for 1 year. So at the time it was sold, it had a net book value of what? Of 6 million. It had a net book value of 6 million. So having that, then we can be able to proceed and we compute this. The normal good. The normal gain. The normal gain will be equal to the selling price. In paragraph 2, we are told this asset was sold for 8,880,000. So that is the selling price minus the carrying amount of the net book value, which is 6 million. So in this case, you can see the asset was sold at a profit of 2,880,000. We need to multiply that with whatever you have here, times the fair value. Remember, the fair value you have said is the same with what? The sales profits. 8.88 million. That is the fair value of the sales profit minus this one, the present value of the lease payment. And that one is given within paragraph 3. Within paragraph 3, the last sentence, we are told the present value of the annual lease payment at the inception of the lease back amounted to 8.4. So this one is 8.4 million. 8.4 what? Million, 8.4 million. And then we divide that with the fair value. The fair value of the sales proceeds is 8.88 million. So this will give us the profit to be recognized by this company. The profit to be recognized by our company. So how much profit will be recognized by our company here? How much profit will be recognized by our company? How much profit will be recognized by our company? Our company will recognize a profit of how much? Our company will recognize a profit of how much? I'm given a figure of 155. Someone to confirm this. 155, 676. Is that the amount you're getting? Is that the amount you're getting? Is that the amount you're getting? Please confirm. Is that the amount you're getting? Yes, that is confirmed by Janet. So that basically what was required here in Roman 1, the amount of profit to be recognized by who? By Winston. By Winston. By Winston. So then Roman 2, 3 of the question, Roman 3, we are required to prepare extracts of financial statements of 𝐕𝐎𝐶 Limited for the year which ended 31st of March 2018. 31st of March of 2018. So basically, this should be the end of the first year, because I hope you can see this asset was actually sold on this date. So mean that this year will end on 31st of March 2018. So we are required to prepare extract of financial statement of which company? Of automatically this company. Yes, this company here, because this is a company to recognize the right of use asset and basically what, and actually the risk liability. Now, even before you do that, the first thing we need to do here is basically to compute one, the right of use asset. We need to compute the right of use asset. We basically depreciate that. And then number two, we already have the risk liability. What we will do is just to prepare the amortization schedule. So let's do this first of all. We compute the amount of the right of use asset. What will be the value for the right of use asset? And this will help us in terms of answering Roman 2, whereby we are required to prepare extract of financial statements for 𝐕𝐎𝐶 Limited for the year which ended 31st of March 2018. 31st of March 2018. So we need to, first of all, to compute the right of use asset. The right of use asset. So the right of use asset. How do we compute this one? We take the previous carrying amount or the previous net book value. So before the asset was sold, what was its net book value? We multiply that with what? We multiply that with the present value of the risk payment, divided that with the fair value, or the sales what? Proceed, or the sales proceed. That's basically how we compute the rate of use asset. So the previous carrying amount, or before the asset was sold, its carrying amount is what you have computed here. It was 6 million. 6 million. We multiply that with the present value of the risk payment. Present value of the risk payment is 8.4 million, divided that with the fair value of the asset, which is the same with the sales proceeds, 8.88 million. And that will give us a value of how much? I'm told that will give us a value of 5,056,75. 676. Is that what you are getting? Are you getting the same value? Are you getting the same value? Yes. So that is the value. Now, what we need to do is basically to depreciate this on a straight line. We depreciate this on straight line. And then from there, we prepare the risk amortization to amortize this one. But even before we do that, can you be able to remember the accounting entries which we made? Because in this case, we said you can be required to show the accounting entries in the books of account of this company on the date the transaction took place, on the date this sales leaseback took place. That is on 1st of April 2017. So maybe just to remind ourselves the accounting entries to be made, because we have a number of accounting entries here. A number of accounting entries. One, we say that this company, that is 𝐕𝐎𝐶, on this date, it sold the asset and basically leased back the asset. One, it will recognize something called the right of use asset. This is an asset account. Being an asset account, it will be debited. So this account will be debited with 675. Still, this company will do what? It will debit the bank account because it sold the asset. So it will debit the bank account with the sales proceed. How much amount was received from the sale of the asset? This amount here, 8,880,000. So that is basically the other account to be debited. After debiting that, our company here will credit I think, three accounts. The first one is the statement of a profit or loss with a gain, which you have computed here. Where do we have that gain? This one, 155,676. The other account to be credited is what? Is the asset account. Which was this asset? This was machine. The machine account. The machine account, because the asset was sold. So the account will be credited to recognize the asset. So it will be credited at the net book value. The net book value is for 6 million here. Or 6 what? Million. And then still we credit something called the risk liability. The risk liability with what? With the amount which you have computed here. 5675. Huh? No, that is the right of use asset. Okay, the risk liability is this one. Which is 8.4. 8.4. And actually we said if you add this and this one, will they be the same? I think no. The risk liability is 8.4. Right of use asset, yeah, this one should be 6. This one should be 6. So they should be the same. Whatever you have debited, whatever you have credited should be the same. Is that coming to the same value? Is it coming to the same? Yes. If you add this and this, whatever is debited should be equal to what you have credited, this plus that. I hope it is coming to the same value. Are you getting the same value? The same value? Yes, yes. So now, is that what was required? No. What we are required to do is basically we prepare financial statement extract of Winston for the first year. So we will show 2 items. Well, actually, we will prepare income statement extract, whereby we are going to recognize 2 items: depreciation on the right of use asset, and number 2, the interest on the lease liability. Then in the statement of financial position, we will basically show what? The right of use asset at the net book value, and number 2, the lease liability, which we must split into 2, the non-current and then the current. So what we need to do, first of all, maybe we can depreciate, we can determine the depreciation of this asset. So what will be the depreciation of the right of use asset? The depreciation of the right of use asset. So the depreciation on the right of use asset, this one will be equal to the value for the right of use asset, this one, 5675, 676. Then this will be depreciated over a period of how many years? This will be depreciated for the time the asset was leased. So if you go back to the information we have in paragraph 3, we are told Winston Limited immediately leased back the machine from 𝐻𝐶 for 5 years. So this one will be depreciated on straight line basis for the next 5 years. So what would be the depreciation per annum? The depreciation per annum here. The depreciation per annum will be 1135, 135. So that is the depreciation per what? Annum. So after doing that, we need to proceed and basically we amortize our lease liability. And actually we do that by preparing the amortization schedule. The amortization schedule. Amortization schedule. So this amortization schedule, we prepare it for how many years? I think for 2. Is it for 2 years? Yes, for 2 years. For 2 years. Because we must have the lease liability at the end of year 1, at the end of year 2. So we have the years here. Basically, the first year will end 31st of March 2018. The other year, 31st of March 2019 here. So we will have the lease liability at the start. Then the next column which follows basically depend with when this Lease payment is paid. The lease payment as per paragraph 3, the lease payment is payable in arrears. Payable in arrears. So payable in arrears means that the lease payment is paid at the end of each year. So if that is the case, our next column here will be for the interest. We compute this interest based on the interest rate, that is the interest rate implicit in the lease. The interest rate implicit in the lease is given in paragraph 3, the last sentence, which is 4.625. So we compute that based on that rate there. Yes. So then we have the other column here for the cash to be paid. And finally, the lease liability at the end of the year. The lease liability at the end of the year. Yes. So the lease liability at the start of year 1, the lease liability at the start of year 1 is given as 8.4. Is 8.4. The lease liability, the present value of the lease payment, 8.4. 8.4. That is the amount we want to amortize. First of all, give me the interest here. The interest, 4.625% of this. I'm told it will give us 388,500. So the cash to be paid at the end of year 1 is basically the lease payment. How much lease payment will be paid at the end of year 1 is 1,920,000. Whatever you record here is what Wavestone will be paying as a result of having leased the asset, 1,920,000. So to get the lease liability here, we take the lease liability at the start, this one. We add the interest, and then we less the cash paid. So this one will be equal to A plus B minus what? Minus C. Minus C. Minus what? AC. Which I'm told will be 68,500. 68,500. So that now will be the opening lease liability here at the end of the following financial year. 68,500. We compute the interest as 4.625% of this, which will give us 317,668. 317,668. Then the cash to be paid remain the same, 1920. 1920, like that. What about the lease liability at the end of year 2? This one is 52,66,168. And I hope you're trying to confirm those values. Are you getting the same values, Frida? Are you getting the same figures, Georgina here? Are you getting the same figures, Mike? So please confirm whether you're getting the same values. Josephine, Mercy, are you getting the same value, Miriam? Are you getting the same value, Steve? Yes, yes. Okay, so now having this, we can be able to answer our questions. And what we are required to do is we prepare financial statement extract. So we will start by preparing the income statement extract, or basically the statement of profit or loss extract for the year which ended 31st of March 2018. So what we need to do here is basically to show what was supposed to be recognized in the income statement of this company. I've said two items of expenses, this depreciation and also this expense, this interest expense. So two items basically are the expenses. So the first one is the depreciation on the right of use asset. So which is this one, 1135,135. And then also we have the interest. And this interest, basically, this one will be taken to the income statement as part of the finance cost. So finance cost of what? Of this one. That is 388,500. Yes. So that what was supposed to be recognized in the income statement. What about the statement of financial position? Statement of financial position. Equally, here we have a number of items. Basically, for the year which ended 31st of March 2018, 2 items, or actually 3 items. So first of all, under the non-current assets, our company will recognize something called the right of use asset. Under the non-current assets, we have the right of use assets, and the right of use asset here will be recognized here at the net book value. What will be the net book value? The net book value will be the value for the right of use asset, which we computed here, 56,75,676 minus the depreciation for that year, which is 11,35,135. So that will be the value for the right of use asset. The value for the right of use asset, the value for the right of use asset 4540 1 word, that is 541. Then our company will also recognize the lease liability here, but now the lease liability recall, we must split this into 2 components, the non-current liability and the current what? Liability. So we said the amount to be recognized here as a non-current liability at the end of year 1 should be the lease liability at the end of year 2. That one is recognized as a non-current liability in the first year. Then the difference between these 2 values, we recognize it here as what? As a current liability. So therefore, under the non-current liabilities, we will have the lease liability. We will have the lease liability. The lease liability. And basically, the lease liability at the end of year 1 here will be this amount here. The lease liability at the end of year 2. So which is the 52,66, 1 word, 168. Then from there, we determine the amount to be recognized as what? As a current liability. As a current what? As a current liability. The amount to be recognized as a current liability, we can just record it here. So under the current liabilities, still we will have what? We will still have the lease liability. The lease liability, and the lease liability should be the difference between these 2. So that decrease basically shows the amount which was payable within the next 1 year. The amount payable within the next 1 year. The amount payable within 1 year, which is 1602. 1602,332. 332. Yes. So basically, that is it. That what is required as far as that question is concerned. A very, very good question. A very, very good question on what is known as the sales leaseback transaction. Sales leaseback what? Transaction. If basically compare what you have done here, you'll be able to see the same concept, or actually the same thing they did in the other question, which I think was in your paper. There was a similar question in your paper. I think, was it around 2021? Yes, I think it was a question which was examined in 2021. Yes. So I think that is it. So what you'll do, can you try to revise on the other areas of leases, how the leases are accounted for by the owner of the asset, that is the lessor, and equally how the leases are accounted for by the lessee. How does the lessee determine the right of use asset? How the lessee does determine the lease liability? And also try to look on the 2 questions we did. We looked on a question whereby the lease payment, the minimum lease payment are payable at the start of the year and also are payable at the end of the year, because we said in terms of how we compute the right of use asset, the lease liability in those 2 instances is actually different. Such that if you happen to come across a question from this area here of recess, then we'll be in a position to comfortably handle that particular question. Sasa? Yes, yes. So for today, once we stop at that particular point, So I think maybe what we will do once we meet on Saturday, we will try to revise on reconstruction. Majorly we said what maybe we will revise on is the internal reconstruction. But there was a question, I think, on merger. I don't know whether I will be able to show you the shortcut for handling that question. Because you never know. They may bring a question on merger, taking into account the question which is there sitting. It was a question on external reconstruction. Maybe I'll try to show you how we do those particular questions for external reconstruction, basically merger, using a shortcut, and then look on a question on internal reconstruction. So therefore, before you meet on Saturday, basically try to look on that. External reconstruction, internal reconstruction, we revise that on Saturday, and then we say next week we go back to the topic of group account. Group account. Sasa? Yes. So for today, therefore, we are going to stop at that point. I don't know whether there is any question. Any question before we wind up? We have any question before we wind up? Any question before we wind up? Okay, so I think there is none. So let's stop at that point for now. Have a good night. We continue from there on Saturday. Yes. So basically, from this particular information which we have there in that particular question, what we are required to do is to compute the break-even sales. So the break-even sales, I've said in other terms, it is the break-even point in shillings. How do we compute the break-even point in shillings? We take the fixed cost, which is basically represented by capital F, and basically we divide that with what? With the contribution margin sales ratio. Now, I'm saying from that particular information, basically in the last paragraph, we already have this one. We have the contribution sales ratio. And actually, I've said the contribution sales ratio is the same with the contribution margin sales ratio. So basically, which is 50%. Now, this one, we can use it in terms of computing something called the contribution. Something called what? The contribution. Something called the contribution. And I hope you can be able to remember what is the contribution. Contribution basically is equal to the sales minus the variable cost. Minus the variable cost. Now, using the information which are given here, how do we compute this one? The contribution will be computed as the 50% because this is now the contribution sales ratio. So it basically means that the contribution is equal to 50% of the sales. 50% of what? Of the sales, or basically 50% of what? Of the revenue. That's what you mean by the contribution sales ratio. The contribution is 50% of the sales, or basically that of the revenue. So in our case, how do we compute this contribution? We will take 50% of the revenue. So in our case, the revenue is given as what? A 60 million. So therefore, the contribution will be equal to that million. Will be equal to that what? Million. So having this contribution, we also know that to get the profit, basically we take something called the contribution margin, and I hope you can be able to recall this. We multiply that with X, and basically we get something called the fixed cost, the fixed what? Cost. I hope you can remember that formula. Now, this profit will therefore be equal to, in our case, what we have here, 30 million. This is the total contribution. And actually, this is the contribution in what? In shillings. So in arriving at this particular figure here, we take the contribution margin per unit, we multiply that with what? With X. So in our case, this has already been computed for us, or basically we already have this figure, which is 30 million. So 30 million. So to that, what do? We less the fixed cost. And actually the fixed cost is what is missing here, because we already have the profit. I hope you can see we have the profit in our questions here. Our profit is basically 12 million. We have the profit, 12 million. We have the total contribution, and what is missing is the fixed what? Cost. Remember that what we want to determine here, so that we can be able to determine the break-even point sales, or the break-even point in what? In shillings. So what will be the fixed cost? We combine the right terms. So we bring the fixed cost to the other side, which now will be a positive, and then we will be left with 30 million. We bring this to the other side, which will be minus 12 what? Million. So meaning that the fixed cost in our case is 18 what? Million. So having the fixed cost, then we can be able to proceed and we compute the break-even point in shillings, or the break-even point in what? The break-even point sales. So the break-even point sales, or basically the break-even point in shillings, will be equal to the fixed cost, 18 million, this one. We divide that with what? The contribution margin sales ratio. I've said the contribution margin sales ratio is what we have here, 0.5. And this will give us what? This will give us a break-even point in shillings of how much? Of how much? Of how much? What are you getting here? Yes, I'm told by Virginia. This will give us an amount of 36 million. That will give us 36 what? 36 million. So at the break-even point, or at this particular point here, or once the company makes sales of 36 million, so basically the company will make what? Will make zero profit. So therefore, that basically what you just needed to know, that anytime you're given the contribution to sales, or actually once you're given the contribution sales ratio, that will help you in terms of computing what? The contribution. So the contribution will be equal to the 50% of the revenue, or 50% of what? Of the sales. Now, having the contribution, you can proceed and basically compute the fixed cost, because we know to compute the profit, we take the contribution minus the fixed cost. We already have the profit, 12 million. We have the total contribution, 30 million. What is missing is the fixed what? Cost. That's why we have been able to compute our fixed cost as what? Is 18 million. So having that, let's move to Roman 2 of the question. And basically what you're required to compute is the margin of what? The margin of safety. The margin of safety, that is MOS. And I hope you can also be able to recall that we compute the margin of safety as the difference between the current sales and the break-even point. And the break-even what? Point. So therefore, to compute this one, the margin of safety, we will take the current sales, basically in shillings, and then to this we less the break-even point in what? In shillings. In shillings. In shillings. So our current sales, currently our company is making sales of what? Over 60 million, and the break-even point in shillings is basically what you have computed here. That is what? That is it. So the break or the margin of safety in our case will be 24 million. So what does that mean? The margin of safety, it basically means that if the current sales of the company reduces with 24 million, the company will start making losses. The company will start making what? Losses. And equally, remember, we say that this particular margin of safety can also be computed as a percentage. How do we compute the margin of safety as a percentage? The margin of safety as a percentage is equal to the current sales. Current sales, basically in shillings. We deduct the break-even point in shillings, and then we divide all this with what? With the current sales. With the current sales still in what? In shillings. So therefore, our margin of safety as a percentage will be equal to this minus this, which is basically 60M minus 36M. We divide all that. We divide all that with the current sales in shillings 60. And remember, because we want to express this as a percentage, we must multiply that with what? With 100%. With 100%. With 100 what? Percent. With 100%. Yes, so that will give us what? That will give us what? Yes, I'm told that this one will give us what? This one will give us 40%. That will give us 40 what? 40%. That will give us 40%. So basically, that is what is required in that question. Is a small one, but basically a tricky one. A tricky question. A tricky question. Now, I want us to look on. There is another question here for break-even, and I feel it is also important we do it. Can we go to the stitching for April 2024? Let's go to the stitching for April 2024. Question number 3B. April 2024. April 2024. April 2024, question 3B. April 2023, question 3B. Yes, I hope you are there. I hope you are there. I hope you are there. Okay. So what are we told here? What are we told? Part B, it reads, luxury weekend county park is an entertainment park that offers individual and family entry tickets. So we are told that tickets include meals, 3 types of beverages, and unlimited use of a swimming pool. Luxury Weekend County Park has the following ticket prices and variable cost for the year 2024. So basically, we are told this is an entertainment park, which is called Luxury Weekend County Park. So it basically has 3 tickets. So the first ticket is called the individual ticket, the family ticket, and also I think we are given the total information. So we're given the selling price of each ticket and the variable cost, which include the cost of meal, the direct labor, the variable cost of beverages, the swimming cost, and then we have the contribution, which is the difference between the selling price and the variable cost. We have the apportioned fixed cost, And these are basically the fixed costs which are apportioned to each of the tickets there, equally the total. And then we have the expected ticket to be sold there. So then we are told, we're given some additional information. We are told, assume all the costs, assume all the assumptions of the cost, volume, profit, CVP, analysis are valid. And then number 2, we are told the sales mix is currently generated by 2 types of tickets in the following proportion. So individual ticket 60% and family ticket 40%. Though even if those particular current sales mix are not given, we can be able to compute that from the expected ticket to be sold. Expected ticket to be sold, because basically what you're given in number 2, those are basically the weight of each ticket, the weight of each what ticket. In other terms, these are like the product of this what, the product of this entertainment pack. So, for example, for you to compute the weight of the first ticket, which is individual, you will take the expected ticket to be sold, which are basically 6,000, and then you multiply that. So you divide that with the total expected ticket to be sold for individual and also the family ticket, and then you multiply that with what? With 100. So automatically, this one will give us 60%. In other terms, the weight of this ticket, the weight of individual tickets will be 0.6. What about the weight for the other ticket, which is basically the family ticket? So we can talk of WF, that is the weight of family ticket. So we will take the number of tickets expected to be sold, 4,000, divided by the total tickets. We multiply that with what? With 100. That will give us 40%, and therefore the weight here is 0.4. So we have that. So what are we required to do here? Roman 1, we're required to compute the weighted average contribution margin at the current sales mix assumed above. So we will start with that Roman 1 of that question, whereby we are required to compute the weighted average contribution margin at the current sales mix, at the current sales mix. So we say the computation of this is basically quite simple. If you can remember what we did in the other question, there is another question which we did on Sunday. So in this case, we can have the 2 product or the 2 tickets of this entertainment park. We have the individual ticket, and then we have the family ticket. Now, for us to be able to compute what is required here, there is something we need to have here. 1, we need to have the contribution per ticket, and basically what? And the weight. That is basically what we need to have. So in our case, we already have the contribution. The contribution for the first ticket, which is basically below paragraph 1, the selling price minus the variable cost is 600. So then the contribution for this other ticket is 1,100. Then do we have the weight? Yes. The weight is what we have here, 0.6 and 0.4. 0.6 and 0.4. So that's basically what we have. And then from there, we can proceed and we compute what we are required. We are required to compute the weighted average contribution margin. How do we compute this one? To compute this one, we will take the contribution margin of the first ticket. We can just use I for individual ticket, the contribution margin for individual ticket. We multiply that with the weight of individual ticket, and then to this we add the contribution margin of the family ticket multiplied by the weight of the family ticket, like that. Okay, so we take this one, that is 600 times the weight, which is 0.6, and then to this we add the contribution margin of the family ticket, 1,100, times the weight of the family ticket, which is 0.4. So this will give us what? This will give us 360. 360. What about this one? It will give us for 40. It will give us for 40. And the total amount here we get what? we get weighted average contribution margin of how much? Of 800, like that. Yes. Yes, so that's basically what we have. So let's move to Roman 2 of the question. In Roman 2, we are required to compute the total number of tickets that luxury weekend counterpart must sell to break even. So the number of tickets to be sold to break even. So the break even in what? In units. So remember, in this case, the units are basically what? Are tickets. So how do we compute this one? We compute this one basically by taking what? By taking the fixed cost, which is represented by capital F. We divide that with the weighted average contribution margin. And remember, in this case, what we are required to compute here are the total number of tickets to be sold, not basically the total individual tickets, not the total family ticket to be sold, but a combination of the total tickets to be sold by this entertainment park for it to be able to do what? To break even. That's why you can see here we are using what? The weighted average contribution margins. So equally the fixed cost, we will use the fixed cost of the whole what? The whole entity or the whole company. And I think we have that below where we have the contribution margin. Below the contribution margin, I hope you can see we are given the apportioned fixed cost. This is the fixed cost apportioned to each product. But are we interested with that? No. What we are interested with, we're interested with the total fixed cost of this entertainment park, which is 7.5. We divide that with the weighted average contribution margin, which is 800, what basically we have computed up here. So, and this now will give us the what? Will give us the total tickets to be sold, including family and the individual tickets to break even. So this will give us what? This will give us what? This will give us 93, 75 tickets. Yes. So those are basically the total number of tickets to be sold. And I've said that this includes both the individual and also the family what? Ticket, the individual and the family ticket. So let's move to the other part of the question, which is basically Roman 3. And remember, in this case, we said even before we move to Roman 3, remember you say that you can be able now to split this, or basically from these total tickets, you can be able to determine the individual ticket to be sold, the family ticket to be sold. So you just use the weight here, this weight. So because now this 60% will be the family individual tickets, and 40% will be the family what? Tickets. But in our case, that is not what was required. We were required to compute the total tickets, including family and individual tickets to be sold to break even. So Roman 3, that is, we are required to compute the margin of safety in units. Remember, units here are tickets. For luxury weekend county park. So margin of safety, this one is equal to the current what? To the current sales, basically in this case in units. So how many tickets is the luxury weekend county park expecting to sell? So the expected, that is the expected or the budgeted sales in units minus the break-even point in what? In units. Remember that in our case, we have said units and tickets. So if you go back to the information we have below the fixed cost, we are given the expected ticket to be sold. So what we will do, we will take the total expected or the total ticket expected to be sold both for family and individual tickets. And basically that is total of 10,000. So this entertainment park currently is expecting to sell 10,000 tickets. So we less the break-even point. The break-even point is 93.75 tickets. So the difference now will be the margin of safety. The margin of safety, which will be 625 tickets. 625 tickets. So mean that if, for example, the current sales, the expected sales, we reduce with the 625, this entertainment park, automatically it will start making what? Losses. It will start making losses. Yes. So let's move to the last part of that particular question, Roman 4. And basically what you're required to do is to calculate the number of individual tickets and the number of, that is, calculate the number of individual tickets and number of family tickets that Luxury Weekend Counterpark must sell to break even. So I think that one is quite simple. Number of what? Number of family. That is, we can start with the individual. Number of individual and family tickets. Family tickets to be sold. To do what? To break even. To break even. So there are two approaches we can use in terms of computing these two approaches. One, we can take this total ticket to be sold for both family and individual, and actually we use now the weight, and we compute the number of individual family ticket to be sold, the number of family ticket to be sold to break even. Alternatively, now we can compute the break even point for individual ticket and family ticket using this particular formula here. So where we will take the fixed cost of each ticket, we divide that with the contribution of individual tickets. Maybe let's see whether if we use the two approaches, we are going to get the same answer. So we will take these total units, which are 93.75 tickets, and basically you say that these are the total family and individual tickets to be sold to break even. So I'll say that we can apply the weight to determine the individual and family ticket to be sold. So the weight for individual ticket is 60%. So the individual tickets to be sold will be 60% of this. 60% of 93.75. And that will give us how many individual tickets? How many individual tickets will be sold in order to break even? How many individual tickets would be sold in order to break even? Yes, so this one would be 56.25 tickets. What about the family tickets? The family. So for family, we will take the weight. We will take the weight, which is basically 40% times 93.75. And this will give us what? Will give us 3750 tickets. 3750 tickets. So equally, I've said there is still another approach we can use. We can use this formula, the break-even point in units, where we will take the fixed cost of individual tickets. We divide that now with the contribution margin, not with the weighted, but the contribution margin for each. So maybe you can start with the individual tickets here. So individual tickets. So for the individual ticket, we will take their portioned fixed cost. Their portion fixed cost is given as what? Their portion fixed cost is given as 33.75. So out of this total fixed cost of 7.5, the amount which has been apportioned to this ticket is 33,75,000. And then we divide that with the contribution margin. The contribution margin for individual tickets, this one, 600. So this should give us the same answer here, 56.25 tickets. Are you getting the same answer? 5625, 5625. Yes, 5625. So we do the same for the family ticket. For the family ticket, we take the apportioned fixed cost. The apportioned fixed cost is 4125, 4125,000. We divide that with the contribution margin, this one 1100. So that equally should give us 750 tickets. That is 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 750 tickets. Are you getting that? Yes. Yes. So therefore, basically that's what was required as far as that question is concerned. Basically, a computation of the margin of safety and also the break-even point. So the marks allocated there were two there, a total of 8 marks. A total of 8 marks. I don't know whether we did we tackle that part C of that question in class? Did we tackle part C of that question in class? Did we tackle part C of that question in class? Or we can just do it? I think it is in relation to break even. It is in relation to, I think, what is it? Something to do with the EOQ and so on. Did you handle that question in class, or we can just do it? Tulifanya ama tuifanye tu? Did we handle that question in class? So we did it, Either we did it in class, Okay. So I think if we did it in class, no need of repetition, no need of repeating it, no need of repeating it, no need of repeating that questions there. No need of repeating it. Okay. Yes, so I think maybe you can just, let's just take a short break of 10 minutes. We come back. I get like 2 other questions, which we are going to do. And maybe you can confirm for me, I don't know whether you can be able to confirm for me very fast. Which questions did we tackle on preparation of income statement using marginal and absorption costing? I think we did like 2 questions in class. 2 questions in class on preparation of profit statement using the marginal and also absorption costing. Marginal and absorption costing, we did 2 questions. We did 2 questions in class, if I'm not wrong. I think we did 2 questions. Is that the position? We did April 2023. We did April 2023. Which other one? Which other one? What about December 2024? I think we also did that one. Yes, December 2024. So we did 2. We did 2 or 3. Okay, so I think we did 2. Okay, so let's just take a short break of 10 minutes. We come back and then I'll get another question. So short break of 10 minutes. We come back after that break. Yes, so the question I want us to do here is for September 2015, pilot paper, specifically question number 5, is a question regarding application of marginal costing. So the question reads, Omega Manufacturers Limited has just acquired a new production facilities to produce product Omega. So the product will be produced in 2 departments, crushing and filtering. So then we are given some additional information about what you're told. The product will retail at a price of 500 per liter. So basically, this is now the selling price per liter. And then you're given the variable production cost, which are as follows. Remember, this particular product here basically will be produced in 2 departments. So the crushing and filtering. So we are given the direct material in crushing department, no material cost be incurred in filtering. Then we have the direct labor in crushing and also filtering. We have the variable production overhead in the 2 departments. And then number 3, we are told the fixed production overhead amount to 5 million for both departments. And then we are told the crushing department is currently operating at full capacity with available labor hours being 10,000. So we are told each unit of Omega requires 0.25 hours in crushing department. So what are we required to do as far as that question is concerned? Roman 1, we are required to compute the break-even point in units and also in revenue. Roman 2, the margin of safety in units. And Roman 3, the current budgeted profit. So let's start with Roman 1 of that particular question. And is part A, Roman 1, whereby we are required to compute the break-even point in units and also in what? In revenue. In revenue, in other terms, that is in shillings. So we start by computing the break-even point in units, which will be equal to the fixed cost divided that with the contribution margin. Remember, this company is just producing one product. The name of the product is what? The name of the product is called Omega. So we already have the fixed cost, which is basically 5 million. The fixed cost, this one is given as the 5M. So what will be the contribution margin? The contribution margin, and this is per unit. The contribution margin per unit is equal to the P, that is selling price per unit, minus V, the variable cost per unit. So therefore, we need to compute this because the contribution margin is not given. So the selling price, this one is given in the additional information number 1. We told the product will retail at a price of 500. So that is the selling price per liter. And then now to this, we need to deduct that is the variable cost. Now, the variable cost, we're given the variable cost of 2 departments. Maybe we can take the direct material for the 2 departments, that is crushing and filtering. So the direct material in that case is 50. Then to this, we also less the direct labor, which is also the variable cost for the 2 departments, 150 and 40, which basically will give us a total of 190. And then to this, we also less the variable production overhead for the 2 departments, that is 40 and 20. And basically that will give us what? 60. So that is basically the total variable cost. Direct material, direct labor, and variable production overhead. So this will give us a contribution per unit of how much? Contribution per unit. Contribution margin per unit. This one will be 110,300. 110,300. Will that give us 200 per unit? Shillings 200 per unit. Is that what you're getting? Shillings 200 per unit. As the contribution margin. Is that what you're getting? Is that what you're getting? Please confirm whether you're getting that amount there. Yes. So having that, then we can proceed and basically compute the break-even point, in units, which will be equal to the fixed cost, 5 million. 5 million. We divide that with the contribution margin per unit. The contribution margin per unit in our case is 200. We have computed that as 200. So this will give us 25,000 liters. Is that what you're getting? 25,000 liters? 25,000 liters? 25,000 liters? 25,000 liters? Yes. So then we move to Roman 2, margin of safety in units. So the margin of safety in units, this one is quite simple. We take the current budgeted sales minus what? Minus the break-even point. Minus the break-even point. And are we given what the company is currently expecting to sell? Okay, so I don't think we have that. The budgeted sales. The budgeted sales in liters, or basically in units, minus the break-even point in what? In units. In units. Are we given this one? Yes. So in revenue is the same with the oh, sorry. Okay, thank you, Ida. Thank you, Ida. Even before we come to this, we also require to compute the break-even point in shillings. The break-even point in shillings, or basically in revenue. So which is equal to what? Which is equal to the fixed cost divided that with the contribution margin sales ratio. Contribution margin sales ratio. So the fixed cost is basically 5 million. We divide with this. I hope you can be able to recall how we compute this. This one is computed by taking 1 minus V divided by P. Divided by P. So we have 1 minus V is the variable cost. The variable cost is basically what we have here, which is 300. So 300 divided that with 500, divided that with 500. So this would be equal to 5 million. 5 million divided that with what? This will be, we simplify this, and this will be 0.6. Is that the position? 0.6 minus 1, which will give us 0.4. 0.4. And that will give us what? 5 million divided by 0.4. 5 million divided by 0.4 divided by 0.4 by 0.4. That will give us what? Yes, what are you getting? 12.5 what? 12.5 million. 12.5 million. There is still another approach you can also be able to use in computing this one. The break-even point in shillings. In shillings, you can take this formula which you have there, contribution, that is a fixed cost divided by contribution margin, and then you multiply that with the selling price per unit. So you can also use this formula here. It will give you the same thing. 5M divided by contribution margin 200 times the selling price, which is basically 500. If you work out that, you should get the same value. Should get the same value. Should get the same value. Are you getting the same value? So this one will give us 12. This one 25 multiplied by 500. Is it coming to the same? Are you getting the same value? Are you getting the same value? Yes, you should get the same value. Now, in Roman 2 and Roman 3, I don't know whether we will be able to answer that because there is something which I feel is missing. Are we given the number of units which are expected to be sold? Because what you're given is in addition information number 1, we're given each product we retail at 500. And then number 3, we are given the fixed cost. Number 4, we are given the labor hours available in the crushing department. And then you're told each unit requires 0.2 F. Okay, yes. I think we can be able to compute that because there is something which are not seen there. Yes, so let's move to Roman 2, the margin of safety in units. Now, the margin of safety in units, this one is equal to the current sales or to the current budgeted sales. Sales in what? In units. In units. Minus the break-even point in what? In units. The break-even point in units. Now, in our case, we already have this, the break-even point in units. In units which are 2,500 liters. Now, if you check on this particular question, we are not given this. What the company is currently expecting to produce and sell. But can we be able to compute that based on the information which are given there? Specifically the information we have in note number 5 and also note number 4. Can we be able to compute the number of units the company will produce and sell? Can we be able to do that? Using the information in note number 4, note number 5. Note number 4, note number 5. Can you be able to compute the number of units to be sold, to be produced and sold? To be produced and sold? Yes, that one is very much possible because in note number 4, we are told the crushing department is currently operating in full capacity with available labor hours of 10,000. So the labor hours available in the crushing department are 10,000. And we are told all these labor hours are currently used. And then if you go to note number 5, actually this was the trick for this question. If you go to note number 5, we are told each unit of omega requires 0.25 hours in the crushing department. So that is the information we should be able to use to compute the number of units the company is budgeting to produce and do what? And sell. Because in this case, we are told to produce 1 unit, or in other terms, to produce 1 liter of this product, it requires 0.25 hours in the crushing department. In the crushing department. So in this case, we are told the available labor hours in the crushing department are 10,000, which are fully utilized. Which are fully what? Utilized. So this means, or basically what we need to do is to compute how many hours, sorry, not hours, that is, how many units are produced, or how many units or liters will this particular company be able to do what? To produce using 10,000 labor hours in the crushing department. Taking into account, we know that to produce 1 unit or basically 1 liter of omega, then it requires 0.25 hours. Can you be able to compute the number of liters or the number of units to be produced? Yes. So we just need to cross multiply, then we divide here. So we will take 1 times 10,000 divided that with 0.25. This will give us the number of liters or the number of units of this product to be produced and sold. Remember, at the CVP, or basically at the break-even analysis, at the break-even point, basically one of the assumption which we make is that we don't have closing inventory. So the unit to be produced will be sold. Sasa? Yes. That is one of the assumptions which we make here. So therefore, this will basically give us what? This will give us 40,000 liters. 40,000 liters. 40,000 liters. So 40,000 liters. So we less the break-even point. Remember, this 25,000. So this will give us 15,000 liters, or let's just refer to it as units. So meaning that if the company by the end of the year will produce and sell 4,000 units, if the sales, the current sales of the company reduces with 15,000 units, the company will start making losses. That is what was required. So Roman 3, we require to compute the current budgeted profit. The current budgeted what? profit. So you have to recall, how do we compute the profit? How do we compute the profit? To compute the profit, we have said we take the contribution margin per unit, the contribution margin per unit, we multiply this with X, we multiply this with X, the number of units to be produced and sold, minus what? Minus F. Minus what? F, the fixed cost. So the contribution margin per unit is something we have already computed here as 300, this one, not 300, 200. This is the contribution margin, 200. We multiply that with the number of units the company expects to produce and sell. Basically, what you have computed here, 40,000 minus the fixed cost. The fixed cost is 5 million. Is 5 million. And this will give us what? Will this give us 3 million? 3 million, sharing 3 million, sharing 3 million, sharing 3 million. Is that what you're getting? Yes. So that now will give us sharing 3 million. So that basically is the current budgeted what? Sales, the current budgeted sales. So let's move to part B of the question. Still, why are we not adding the fixed cost? Why are we not adding the fixed cost? Which fixed cost? No, do we have fixed cost for two departments either? There is no way we're given the fixed cost for each. So the fixed cost which you are given there, 5 million, is for the two departments. That leads to point number 3. The fixed production overhead amount to 5 million for both departments. So 5 million is for both the departments either. Or what are we supposed to add here? It should be, I think our computation there is very much correct. Either. Do we have any fixed cost we have omitted from our computation? Any fixed cost we have omitted? Because 5 million is for both. I hope you can see that. It's for both. It's for both departments. For both departments. Okay. Now, let's move to part B of the question. And what we are told is that a customer has offered to purchase 2,000 units of a product alpha, another product that Omega produces. Omega Manufacturers Limited can produce with a new production facility. So we are given the cost data. The cost data is available. The cost data is as follows for product alpha. So product alpha still will go through the two departments, crushing and filtering. We have the direct material in crushing, direct labor in crushing and filtering. We have the variable production overheads for the two departments. Number 2, we are told each unit of alpha requires 0.5 hours in crushing. And then we are told that the customer has offered a price of 1,500, the customer has offered a price of 1,500 per unit of alpha. And then you're told the incremental fixed cost associated with the offer amount to 1 million. So what are we required to do? We are required to advise the company on whether to accept the offer, whether to accept the offer. So basically, this is an offer which is offered by a customer. And I think this is something we discussed under the application of marginal costing in respect to non-routine decisions. We said, if, for example, the company ordinarily produce and sell a certain product, maybe at a price of like 2,000, a company can get a special offer from a customer. What is a special offer? This whereby a customer is requesting to be supplied with that product at a price below the normal selling price. Below the normal selling price. So basically, we said what the company should consider is whether that particular special offer from that customer will give rise to a contribution. You take the selling price and then we less the cost which are associated with that particular offer. And actually, we say the costs which we consider here mostly are the variable costs, because we say that whether the company accepts that offer or not, the fixed cost will have to be incurred. But if you check on that information which are given there, we are told other than the fixed cost which will be incurred in relation to this offer, there will be some incremental fixed cost. That incremental fixed cost is purely associated with this particular offer. So in computing the profit or the contribution from this particular offer, we will also consider that incremental fixed cost. We will take the sales, we less now the cost associated with that offer. If by the end of the day the company will be getting a profit, we advise the management to do what? To accept the offer. We advise the company to accept the offer. If the company will not be getting any profit, the offer give rise to a loss, we advise them not to do what? To accept the offer. So what we need to do here basically is to prepare a profit statement. A profit statement. We compare the sales from this offer. The sales will be equal to what? The sales will be equal to the selling price. The selling price in this case, in note number 3, Roman 3, we are told the customer has offered a price of 1,500. So this customer is requesting to pay each unit 1,500, 50 shillings, 1,500. So, and then we multiply this with the number of units which the customer is willing to purchase. So that is given within paragraph 1. A customer has offered to purchase 2,000 units. So this customer has offered to buy 2,000 units at a price of 1,500 each. So what will be the sales associated with this particular offer? The sales associated with this particular offer. The sales associated with this particular offer will be how much? Will be 3 million. Will be 3 million. 3 million. So what basically we need to do is to less the cost associated with what? Associated with that particular offer. For the company to be able to deliver this offer, which cost will be incurred? So automatically the direct, the variable cost will be incurred. So we start with the direct material. The direct material. And in this case, for the direct material, we can take the total direct material in the 2 departments, which will be 250 plus 0, or alternatively, you can just split that here. So for direct material, compute for the first department, which is crushing, which will be 250 times the number of units to be produced, which is 2,000. So this will give us what? This will give us 50 and 4 zeros, which will give us 500,000. Is that giving us 500,000? 500,000? Yes. So there is no direct material to be incurred in the other departments, that is filtering. No direct material. So then from there we take the direct labor cost. The direct labor cost. So for the direct labor cost, we will compute this for the 2 departments, starting with crushing. We will take the labor hour per unit, which is basically 150, times the number of units to be produced and supply to this customer 2,000. That will give us what? 300,000. So for the other department, that is filtering, what will be the labor cost? We take 40 times what? Times 2,000 times 2,000, and basically that will give us what? That will give us 8 and 4 zeros. 8 and 4 zeros, which will be 80,000, which will be 80. Okay, am I taking the correct values? Oh, sorry. I went back to Roman 1. I went back to part 1. So we should be in part 2, sorry, part B. So this one should be 250. This one should be 250. Is that the position? 250. This one should be 250 times 2,000. Yes, so okay. So that is, okay. This one is correct. Material 250 times 2,000 is correct. So this is what we need to change. The direct labor here will be 300 times this one, which will give us what? Which will give us 600,000. So for the other department is 80. Sorry for that. I went back to Roman 1. Yes. So and this one will give us what? This one will give us 160. Will give us 160. So then from there we have the variable production overheads. The variable production overheads. So for the variable production overhead for the first department, which is crushing, it will be equal to 50 shillings. 50 shillings times the number of units to be produced, which will give us 100,000. And then for the other department, that is filtering, we take 20 times 2,000, which will give us what? 40,000, which will give us 40,000. 40,000. And then from there, we are also told in what? We are also told in Roman 4, the incremental fixed cost associated with this offer is 1 million. So there is incremental fixed cost. So mean that if the company will not accept this offer, that there will be no increase in the fixed cost. So that incremental fixed cost, because it is associated with this particular offer, we also need to consider that here. Incremental fixed cost. Incremental fixed cost, which is basically an amount of how much? An amount of 1 million. An amount of 1 million. So I think those are the costs which are basically associated with this particular offer. The cost associated with that offer. So we need to compare the costs of the offer with the sales. We see, will the company make any profit? If the company will make some profit, we advise the company to accept the offer. If the company will not be making any profit, reject that offer. So can you give me these totals here? This will be 1.1, 1.2, 1.6, 2.6, and 160. So this will give us 2760. 2.4. 2.4, yes. 2.4. So basically we less that from what we have up there. And I hope you can see that this one will give rise to a profit. So there will be some profit the company will get here, which is equal to 600,000. So the company will get a small profit there of 600,000. So what will be the advice here? The advice is that the company should accept the offer. So advice, the company should accept the offer. Should accept the offer since it results to some profit, since it results to a profit, it results to a profit of 600,000. It results to a profit of 600,000. So the offer should be accepted. It is resulting to a profit of 600,000. 600,000. Yes. So that is it. That's what was required. So let's move to the last part of the questions here. Let's move to the last part. The last part. So the entire question here was on application of marginal costing. Yes. So we are told in part C, the management is considering a proposal to establish a new market in the neighboring county for product Omega. This will require expansion of the production facility. So we are told the proposal will increase the cost as follows. One, the advertising expense will increase with 10% of the revenue. Traveling expenses will increase by 10% of the prime cost. I hope you can remember prime cost. Prime cost is the total of the direct, or is basically the total, prime cost is the total variable cost. The variable or the direct, not variable, sorry, but the total direct production cost. The total direct production cost. So the total direct production cost will include direct material, direct labor, and the variable production overheads. So the traveling expenses will increase with 10% of the prime cost. Fixed production overheads will be 2.5. And then you're told the targeted annual sales volume will be 10,000 units in the new market at a price of 900 per unit. So we are required to advise the management on whether it should make product Omega. Okay, advise management on whether it should market product Omega in the new what? In the new market. So just like what we have done here, we need basically to evaluate whether there will be some new profit which the company will get from the new what? Market. Once the company venture into this new market, will there be some profit? So if there will be some profit, then in this case, we advise them to venture into the new market. If there will be no profit, we advise the company not to do what? To venture into the new market. Yes, so basically for us to do that, we need to prepare a profit statement. We need to prepare a profit statement. A profit statement. So in this particular profit statement, I think we can start with what? We can start with the we can start by computing what? The contribution, instead of using the longer approach of computing the sales, raising the variable cost, because it is important for you to note that once this company venture into the new market, one, the company will have to incur the normal variable cost. The normal variable cost are the ones which are given up there in Roman 1. The company will incur the direct material cost, the direct labor cost, the variable production overhead is given up there in the first paragraph of the question. Those costs will have to be incurred. So yes. Now, instead of using now the wrong route of computing the sales, raising those particular variable costs, and then we get the contribution, and then we raise now this incremental cost, I think we can use now this particular approach here. So we first of all compute what? Compute now the contribution, where we are going to take the contribution margin per unit. We multiply that with X, the number of units the company is targeting to sell in that new market, in that new what? Market. And then now to this, we less the costs which are associated with the new market. Costs are associated with the new what? With the new market. With the new market. With the new what? Market. Remember, in this case here, the fixed cost will not be considered. A fixed cost will not be what? Fixed cost will not be considered. The fixed cost of 5 million, that one will not be considered, because whether the company venture into the new market or not, by the end of the day, the fixed cost of 5 million will be what? Will be incurred. That cost will not be considered. What will be considered is the incremental fixed cost we are given in note number in part C. That is the cost, the fixed cost we are going to consider. So the fixed cost of 5 million given below paragraph 1 will not be considered here, because whether the company venture into the new market or not, by the end of the day, that cost will be what? Will be incurred. So this is basically the approach which I want us to use here, instead of using a wrong route. So we compute this one, contribution per unit. We multiply that with the number of units which are targeted to be sold in the new market, and then we less the cost associated with the new what? Market. The cost associated with venturing into the new market. So therefore, we compute the contribution. The contribution, and this now will be the total contribution. That will be the contribution margin per unit. The contribution margin per unit is what we had in Roman 1. I hope you can remember in part A up there, we computed the contribution margin as what? It was 500 minus 300. Minus 300. And actually that was giving us the contribution margin of 200. The contribution margin per unit, was it 200? Was it 200? Contribution margin per unit as used in part A. Was it 200? Was it 200? Yes. So we take that, we multiply this with the number of units which are targeted to be sold in the new market. In part C, the last sentence we are told, the target annual sales will be 10,000 units. So the company is targeting to sell 10,000 units in the new market. So what will be the contribution from the new market? The contribution from the new market will be what? Will be 2 million. Is it coming to 2 million? 1, 2, 3, 4, 5, 6. 1, 2, 3. Yes, it will be 6 million. It will be 6 million. Now, what we need to do, we need to let the cost associated with the new market. The cost to this we less the cost associated with the new what? With the new market. With the new market. So in this case, I've said the costs associated with the new market are the costs we have in part C. So, and that's why we have said that the fixed cost, which is given up there in part A, will not be considered here because that cost will have to be incurred. Whether the company ventures into the new market or not, by the end of the day, the cost of 5 million will be incurred. So as far as making this decision is concerned, as far as making the decision whether to venture into the new market or not is concerned, the fixed cost of 5 million is an irrelevant cost. Is an irrelevant cost. We will not consider it here. So we will only consider the cost which you have in note in part C. So the first cost is basically advertising. The company will have to advertising expenses. So the advertising expenses here will be 10% of the revenue. So the revenue is this one, 2 million. So this one will be 200,000. 200,000. So then the company still will incur some traveling expenses. Traveling expenses, which in our case we are told will be 10% of the prime cost. Remember, I've said the prime cost. The prime cost. This is basically equal to the total direct production cost. The total direct production cost. Now, the total direct production cost, this one will include the direct material, the direct labor, plus the variable production overhead. The variable production overhead. And basically, as per the information we have below paragraph 1 up there, the direct material, I think for the two departments, yes, for the two departments will be 50 plus 0. 50 plus 0, which basically will be 50. Direct labor will be 150 plus 40, which basically will give us 190. What about the variable production overhead? That one will be 40 plus 60 plus 40 plus 20, which will give us 60. And I think this now will give us a total prime cost of what? Of 300. So the prime cost here will be 300. So the traveling expenses will be 10% of the prime cost. And actually, because this one is per unit, we have to multiply this with the number of units which are targeted to be sold in the new market. In the new what? In the new market. So this will give us what? This will give us 30 times this, which will give us what? Is it 300,000? 300,000? Yes, 300,000. So then from there, the company, as a result of venturing into the new market, will incur fixed production overhead over 2.5. Of 2.5. The company will incur a fixed production overhead of 2.5. Now, what we need to do basically is we determine, will there be any profit which will be realized from venturing into the new market? Will there be any profit which will be realized from venturing into the new market? So I think in our case here, we will have what? We have 2 million minus this. Basically, this is a total of 2.83 million. So I think venturing into the new market will basically result to a loss. Is it resulting to a loss of 1 million? Will that result to a loss? Will that give rise to a loss of 1 million? A loss of 1 million? Yes. So which advice do we give to the management here? Which advice do we give to this company? Should they venture into this market? Should they venture into this market or not? Should they venture into this market or not? Should they venture into this market or not? Either. Should they venture into this market or not? They should not. They should not. So the advice is Omega Limited, Omega Manufacturers Limited should not venture into the new market. Venture into the new market. Should not venture into the new market. Since it will result. Since it will result to a loss. To a loss of what? Of $1 million. It will result to a loss of $1 million. It will result to a loss of $1 million. It will result to a loss of $1 million. It will result to a loss of $1 million. A loss of $1 million. A loss of $1 million. So that basically what was required as far as that question is concerned is a good question, because you can see is a general one, is a question which basically entails application of marginal what? Of marginal costing. Yes. So I think for today, let's just stop at that point. I will try to get a question maybe on the preparation of the profit and loss statement using marginal and also absorption costing. We revise on that on Sunday, and maybe from here we basically have to pick some few questions from the other topic of is it accounting for offsite? Yes, I think accounting for offsite. We will pick a few questions from that. We revise on them. Maybe also we can revise on something to do with the offsite costing. The issue to do with the preparation of the offsite analysis sheet. Basically the computation of what? That is the issue to do with the secondary distribution, the offsite absorption rates using ABC, using the traditional methods. Maybe that's what we're going to revise on Sunday. But also this Friday, we have a makeup. We will have a makeup on Friday. I think we agreed from 5 to 7 p.m. Is that what you agreed? I want us to look on, there is this topic, which is the remaining costing methods. At least we do something to do with the service costing, job costing, and maybe see whether we will be able to start on process costing. It's not a long topic. I think with 3 classes, it should be done. We meet at this time. Friday, 5 to 7. We need to do a small sacrifice this month, because I think we have from next week. Do we have 2 weeks which are remaining? Yes, I think we will be having like 2 weeks. 2 weeks which will be remaining. So let's just do a small sacrifice in preparation of the exams. Yes. So let's meet on Friday. On Friday at this time, 5 to 7, so that we can look on that topic of costing methods. I think we have 3 areas: service costing, job costing, and also process costing. Which time is appropriate? Is it 5 a.m. or 6 a.m.? Which time is appropriate? Because I know most of you report to work. 6 or 5? 6 or 5? No, we are not talking of PM. We are talking of AM. AM in the morning. AM in the morning. We are talking of AM in the morning. Yes, AM in the morning. AM in the morning. We just maybe need to sacrifice like 2 weeks, and then we will, not 2 weeks, rather, like 2 classes, then we will be able to see. Okay, sawa. So 5 then on Friday, we meet at this time, 5 to our today's class. And I want us to discuss on this last concept as far as this topic is concerned. And the topic is Well, actually, the sub-topic is preparation of group accounts, specifically whereby the parent company has invested in an associate, or basically the parent company has invested in a joint venture. So the first thing we need to ask ourselves here is what is an associate, and also what is a joint venture. So maybe you can start by defining what is an associate. What is an associate? And basically, in this case, an associate, we say that this is an entity in which the parent company exercises something called the significant influence. So this is an entity, where the parent company, I hope you can also be able to recall that the parent company is called the investor company. The parent company or the investor company exercises something called significant influence. So when talk about the parent company exercising significant influence, this basically means that the parent company is not in a position to control the operating and financial decisions made by the associate, or even to control its composition of the board of directors, but the parent company is able to influence the operating and financial decisions which will be made by the associate company. Now, a parent company, or basically an investor company, is said to exercise significant influence over the associate if the parent company has acquired shares which lies between 20% to 49%. If, for example, in this case, we are told 𝐎𝐍𝐿imited acquired shares which lies between 20% to 49% of the shares issued by 𝐉𝐿imited, it basically means that this company here will be able to influence the operating and financial decisions made by 𝐉𝐿imited. So this company is not able to control the operating and financial decisions of this, but it is purely able to influence. It is able to influence. So therefore, anytime you're given a question and you're told the investor company or the parent company acquired shares which lies between 20% to 49%, it automatically means that the investee company, this company here, is an associate. Is what? An associate. So that is basically the definition of an associate. And then from there we have the other entities here, and basically that is the joint venture. So when we talk about a joint venture, this is an entity in which the parent company and another entity acquire something called a joint control. So this is an entity where the parent company, and another entity acquires joint control. So in this case, when we talk about the parent company and the other entity acquiring a joint control, it basically means that assuming we have two companies, 𝐴𝐿imited and basically 𝐵𝐿imited, so this company may enter into an agreement to acquire equal shareholding or to acquire equal shares in maybe a company which is called 𝐶𝐿imited. So this company acquired 50% of the shares. The remaining 50% of the shares are acquired by 𝐵𝐿imited. So in this case, we say that these two companies have acquired a joint control in C. Joint control means that the operating and financial decisions of this company here, that is C, will be jointly controlled by A and B. So A and B will be jointly controlling the operating and financial decisions which are made by C. And therefore, this company here, we refer to this company as a joint venture. We refer to this particular company as what? As a joint venture. Now, having known what is an associate and basically what is a joint venture, the other thing we need to ask ourselves here, how does the parent company prepare the group account whereby the parent company has invested in an associate or invested in a joint venture? Now, the preparation of group account in this case is governed by this particular standard, which is International Accounting Standard number 28. And this particular standard requires that whenever the parent company has invested in an associate or basically invested in a joint venture, the group account, the consolidated financial statement should be prepared using the equity method. So the group account, in this case, we can say a group account, all the consolidated financial statements should be prepared using the equity method. So equity method basically is a method of accounting, and this particular method, how is it applicable in preparation of the consolidated income statement? How is it applicable in the preparation of the consolidated statement of profit or loss? So first of all, I want us we look on how this method is applicable when it comes to the preparation of the consolidated statement of profit or loss. So how do we apply this method? Now, number one, when the parent company has invested in an associate or basically a joint venture, and we are preparing this, we are saying we should be able to do that in accordance with the equity method. Now, this method requires one, when preparing this, similar items of revenue and expenses, those of the parent company and those of the associate, or those of the joint venture, should not be consolidated, should not be combined. Should not be what? Should not be combined. So if the parent company has invested in an associate, has invested in a joint venture, you are preparing this, the consolidated statement of profit or loss, we are saying use equity method. And actually, according to the equity method, we are saying don't consolidate. Don't consolidate similar items of revenue and expenses, those of the parent and those of the joint venture. Like what we are doing in case of an investment in a subsidiary. We said in our previous discussion, once the parent company has invested in a subsidiary and you are preparing this, you should combine similar items of revenue and expenses, those of the parent and those of the subsidiary. But in this case, we are saying we don't do that. So instead, what we include here, as far as the associate or joint venture is concerned, is the group share. The group share, low associate, or basically joint venture, profit after tax, and other comprehensive incomes. Another comprehensive income. So what we need to do basically is to determine what is the parent company share of the profit after tax, and also the other comprehensive incomes, which were reported by the associate and also the joint venture, and then we include them within the consolidated statement of profit or loss. But in this case, we are saying never make a mistake of consolidating revenue and expenses, those of the parent, those of the associate, or those of the joint venture. Instead, what we include here is the parent company share of the associate or joint venture profit after tax and other comprehensive income. Then from there, let's look on how this method is applicable when it comes to the preparation of the consolidated statement of financial position. Consolidated statement of financial position. Consolidated statement of financial position. Now, first of all, recall what we said in our previous class. Anytime the parent company has acquired a subsidiary and you're required to prepare this one, consolidated statement of financial position, we said you combine, you add together similar items of assets and liabilities, those of the parent, those of the subsidiary. Is that what we do here? No. So according to the equity method, when preparing the consolidated statement of financial position and the parent company has invested in an associate or basically a joint venture, we don't combine similar items of assets and liabilities, those of the parent and those of the associate or those of the joint venture. So in this case, we can say similar items of assets and liabilities, liabilities, those of the parent company and those of the associate or those of the joint venture, they are not consolidated. Not consolidated means that they should not be combined. They should not be combined. Like what we are doing in case of an investment in a subsidiary. Here we don't combine. Instead, what do we include here? What do we include in the consolidated statement of financial position as far as the associate or the joint venture is concerned? We include something called the investment in associate, or basically investment in what? In the joint venture. So we have to compute something called the investment in associate, or basically investment in what? Joint venture. And actually we include that, we recognize that as a component of non-current asset in the consolidated statement of financial position. So how do we compute this one? To compute the investment in associate or the investment in joint venture, we start with the cost of investment. So the cost of investment, basically, this is a purchase consideration which was paid by the parent company in acquiring the shares of the associate, or basically acquiring the shares of the joint venture. So how much purchase consideration was paid? And then to this we add the group share of post-acquisition retained earnings, and any other post acquisition reserve, So when we talk about the post-acquisition retained earnings, post-acquisition reserve, this refers to any reserve of the associate, or basically the joint venture, after it was acquired. So the retained earnings of the associate of the joint venture after it was acquired, or any other reserve of the associate or joint venture after it was acquired, or which must be a post-acquisition. So compute the group share of that. And then to this you less impairment loss. In most of these particular questions, will be told that the investment in associate or the investment in joint venture had impaired with a certain value. When talk about impairment of investment, this whereby you can invest your money in the company, but that investment loses value. You invested maybe by buying shares having a value of 200,000, but because the company where you invested has been making losses, it has not been able to pay dividends, your investment has reduced in value. The value of the shares you bought has lost some value. So that loss of value of the investment which you made in a company is called an impairment loss. The same case, the parent company may have invested in an associate or joint venture which has been making losses, and therefore you can be told the amount invested in the associate or the joint venture has lost some value. That is called an impairment loss, and basically we should deduct it here. Whatever we get here is basically what is known as the investment in what? In associate, or basically investment in joint venture. And basically this is the only item which is basically recognized. The only item which is recognized in the consolidated statement of financial position as far as the associate or the joint venture is concerned. We don't combine similar items of assets and liabilities, those of the parent and those of the associate, or basically those of the joint venture. Yes. So therefore, basically that's what you need to know. But if you can be able to recall what I said, is that most of the questions you will come across in the past papers, you'll be given three companies. You'll be given the parent company. You're told the parent company acquired a subsidiary, and also the parent company acquired an associate, or basically a joint venture. So you have three companies. Now you have to remember what we have discussed here. We have said in case the parent company has already acquired a subsidiary. So whenever we are preparing this consolidated statement of profit or loss, we combine similar items of revenue and expenses, those of the parent plus those of the subsidiary, those of the parent plus those of the subsidiary. In this case, I've said we don't include the revenue and expenses of the associate here. of the associate here. So we don't consolidate the revenue and expenses, those of the parent and those of the associate or those of the joint venture. So you only combine for these two companies. So the same case, when preparing this consolidated statement of financial position, you are not supposed to combine to consolidate similar items of assets and liabilities, those of the parent, those of the associate, or those of the joint venture. So you should only combine similar items of assets and liabilities, those of the parent and those of the subsidiary. So we have said what you include here, as far as this associate or joint venture is concerned, is this item. You have to compute this item: investment in associate, investment in joint venture. That's what you recognize here. So here, what you recognize as far as this company is concerned is the parent company share of the associate or joint venture profit after tax and other comprehensive income. Other comprehensive what? Income. So basically, that is it. That's what you need to know as far as this is basically concerned. And I think with that, we can look on a question. I want us to look on a question on this. We look on a question on this. And basically from there, we should be done. So what will be remaining is for us to be able to do more questions on this. To be able to do more questions on this. I want us to start with basically a simple question here. We can start with a simple question. So let's look on this question for August of 2023. Let's go to the question for August 2023. August 2023. So once you get the question, please confirm. August of 2023. And this is question number 3. That should be question number 3. 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 Yes, I hope you are there. I hope you have that question with you. Are you there? Yes, yes. So what are we told? What are we told here? So we are told that PICA Limited, a public limited entity intended to expand its operation by acquiring investment in other entities. On 1st of November 2022, PICA Limited secured 75% equity interest in Shiba Limited under the following terms. Number one, you're told an immediate cash payment at a fair value of shillings 13 per share on 1st November 2022. Number two, an issue of 3 ordinary shares of shillings 10 per value in PICA Limited for every 5 shares acquired in Shiba. The fair value of PICA Limited shares was shillings 13 at the date of acquisition. The share issue has not been recorded by PICA Limited. So, and then you're told on the same date, PICA Limited also acquired 30% equity shareholding in Amua, paying shillings 24 million in cash. So then we are told the following draft statement of financial position as at 30th of April 2023 relates to PICA Limited and Shiba Limited. So we're given the statement of financial position for the two companies, PICA and Shiba. We have non-current asset, current asset, equity, non-current liabilities, and current liabilities. We have additional information, number 1 all the way to note number 6. And then what are we required to do here? we are required to prepare on number 1 or part A to calculate the value of goodwill arising on acquisition of Shiba. Part B, determine the value of investment in 𝐎𝐻𝐶 Limited as at 30th of April 2023. And part C, we are required to prepare the consolidated statement of financial position of Pika Group as at 30th of April 2023. So before we do that, before we answer our question here, the first thing we need to do, number 1, is basically to come up with a group structure. We said anytime you come up, you come across a question for group account, the first thing you need to do is to come up with a group structure. Then from there, we will go through the additional information. We see, are there some workings which are required? So therefore, let's first of all, we come up with a group structure. So basically, working 1 here will be the group structure. The group structure. So which information do we have about this? We are given information about the group structure within paragraph 1. We go back to paragraph 1, you're told, Pika Limited, which is a public limited company, intends to expand its operation by entering by acquiring investment in other entities. So we are told on 1st of November 2022, Pika Limited secured 75% equity interest in the company which is called what? Shiba. So we are told this company which is called Pika Limited, we are told secured 75% equity interest in the company which is called Shiba Limited, and we are given the date of acquisition, which is 1st November 2022. Remember, this is now the date of acquisition, the DOA. So we are given the terms of acquisition. Those terms, these are the payments which were made. We are going to compute that when answering part A of our question. And then in the last, there is the last paragraph down there where we are told on the same date. I hope you can see that paragraph. We are told on the same date, that is basically this date, we are told Pika Limited also acquired 30%. This company on the same date, 1st November 2022, it's also acquired 30% equity shareholding in a company which is called 𝐻𝐻𝐶 Limited. 𝐻𝐻𝐶 what? Limited are paying shillings 24 million cash. It basically means that this company here, 𝐻𝐻𝐶, this will be an associate because you can see the shares acquired lies between 20% to 49%. This is basically an associate. So, but this one, Shiba, this one is automatically a subsidiary company, whereas now Pika Limited will be our parent. So the company which should prepare the group account, we said is always the parent. The group account should be prepared by which company? The parent company. And basically now we have the date of acquisition. Even before we move to computing maybe what is required, we said it is also important for you to be able to identify 2 dates. The 2 dates, the date of acquisition, which is abbreviated as DOA, and the date of consolidation, the DOC. The DOC is the date we require to prepare the group account. So we can only be able to get this date in our requirement. When are we required to prepare the group account? Can we go to part C of that question? In part C of the question, we are required to prepare the consolidated statement of financial position on 30th of April 2023. So the date of acquisition here, you can see it is 1st November 2022. So what we need to determine here is, were these companies acquired in course of the current financial year? If you can be able to remember the question we did in our previous class, the question for 𝐎𝐻𝐶 and Twende, I hope you can be able to remember our subsidiary was acquired 5 years back. So, but in this case, you can see this subsidiary or these 2 companies look like they were acquired during the current year, because even year is ending April, the next year will start 1st May, that is 1st May. So it means that this year started on 1st of May, but 2022. So therefore, you can see this date of acquisition, it falls within the current year. So these 2 companies were acquired in course of the current year. So how many months do we have here? So we can literally count. We have November, December, January, February, March, April, because that year is ending on April. How many months are those? 1, 2, 3, 4, 5, 6. So it basically means that these two companies, that is Sheba and Pika, they were basically acquired 6 months to the end of the year, 6 months to the end of the year. And we say this is very, very important, specifically when preparing the consolidated statement of profit or loss. If, for example, in our question, though that is not a requirement, if you are preparing, we are required to prepare the consolidated statement of profit or loss. In this case, we say we take the revenue and expenses of this company that is Sheba, basically for 6 months from the date it was acquired. So we take the revenue and expenses of Sheba for just 6 months by basically apportioning its revenue and expenses on time basis, and then we combine with that of the parent. But in our case, we are not required to prepare the consolidated statement of profit or loss. So therefore, it is important to note that these two companies were acquired 6 months to the end of the year. Now, having that, I want us to go straight to the additional information we see. There are some workings we need to do before we even answer our question. So in Roman 1, let's go to Roman 1, we see what you're told. So in Roman 1, you're told at the date of acquisition, the fair value of Sheba Limited, which is basically our subsidiary here, of Sheba Limited net asset approximated their carrying amount with an exemption of plant whose fair value exceeded its carrying amount by 10 million. So we said, if you see this, and we say this is something you'll come across in all questions for group account, the fair value adjustment, the fair value exercise, which we said is the devaluation of asset by the subsidiary company on the date of acquisition. So we said because the subsidiary company devalued the asset but never accounted for that, we said in preparation of group account, we make two adjustments, the revaluation adjustment and the depreciation adjustment. So we are told that the plant was valued and basically its fair value exceeded its carrying amount by 10 million. Then in the other paragraph, we are told the plant had a remaining useful life of 10 years at the date of acquisition, and then you're told the plant is being depreciated on straight-line basis. The plant is still carried at its carrying value in Sheba Limited financial statement. In other terms, it means that this company devalued the plant but never accounted for that. That's why it is still carried at carrying amount. In the last point of note 1, we are told no fair value adjustment was necessary on the acquisition of Amua. This company didn't devalue the asset. So in that case, what you're given in note 1 is something called the fair value adjustment or the fair value exercise, specifically by which company? By Sheba Limited. So in this case, we said we have to make two adjustments as far as this is concerned. The first adjustment, and this is exactly the same thing we did in the other question. The first adjustment is called revaluation adjustment. And actually, we said this is an adjustment which is made in relation to the revaluation gain or loss. So if you check on the information which are given in paragraph 1, this company Sheba did fair value adjustment. The net asset, the fair value of the net asset approximated the carrying amount with an exception of an item of plant whose fair value, that is what is important, whose fair value exceeded, the fair value was exceeded or was more than carrying amount. The carrying amount we said is also known as the net book value with 10 million. But if you check our figures up there, in our statement of financial position, our figures will be able to see them in thousands of shillings. We must also be consistent. We are going to work with all our figures in thousands of shillings. So this or the fair value of the plant was more than the carrying amount with 10,000 or with 10 million. So this one automatically is a revaluation gain. We said anytime the fair value exceeds the carrying amount is the revaluation gain. And because this revaluation gain was not accounted for by this company, we said this one will be added to the group PPE. This one should be added to the group PPE. And number 2, we said that this 10,000 is a pre-acquisition revaluation reserve. When computing the goodwill on acquisition of Sheba, this will be one of the pre-acquisition reserve we are going to use. So number 2, we make the other adjustment, which is called the depreciation adjustment. Depreciation adjustment. In this case, we said we compute something called the depreciation adder charge. the depreciation under charge, and that is depreciation under charge specifically by Shiba Limited. We compute depreciation under charge by who? By Shiba Limited. I hope you can be able to recall the formula which we use here. We said we take what? The revaluation gain, the exact thing we did in our question, in the other question, the revaluation gain. We divide that with the remaining usufruct, and then in this case we multiply that with the proportion of time. Proportion of time, of which we said proportion of time is basically the time we have from the date of acquisition to the date of consolidation. And I hope you can be able to recall here, that from the date of acquisition to the date of consolidation, I hope you can be able to recall we have how many months? 6 months. So these two companies, or actually Shiba was acquired 6 months to the end of what? To the end of the year. So this formula is what you need to remember always, is what we use in computation of what? The depreciation under charge. So therefore, to compute this depreciation under charge, we take the revaluation gain, which is this one, 10,000. 10,000. We divide that with the remaining usufruct. So what is the remaining usufruct of this plant as per the information we have in note number 1? As per the information we have in note number 1, we are told paragraph 2, the plant had a remaining usufruct of how many years? Of 10 years. Of 10 years. I hope you can be able to see that. Of 10 years. So that is the remaining useful life. And then we multiply that with the proportion of time. The proportion of time here will be 6 all over 12. 6 all over 12. That's basically how we compute the depreciation under charge. If you take on what you have done in this question, whatever we did in the other question is just the same. It's just the same. And basically I've said that this is an adjustment you'll come across in all questions for group account. In all questions for group account, you'll be told the subsidiary company on the date it was acquired, it revalued the asset. You must be able to record the adjustment which you make as far as that is concerned. So this will give us what? This will give us 1,000. A half of that is 500. I hope you're getting 500. So this 500 will be adjusted in which two items? One, this one will be deducted from the group PP in preparing a consolidated balance sheet. And then we also deduct it from the retained earnings of this company. The retained earnings of this what? Company. Now, if in this question also we were preparing the consolidated statement of profit or loss, this one we said we added to the group cost of sales. But automatically this adjustment is not necessary, simply because we are not preparing the consolidated statement of a profit or loss. So we will just add that, less that from the group PP, we less it from the retained earnings of who? Of Shiba. Of who? Shiba. So let's move to point number 2. In point number 2, we are told that on 28th April 2023, 28th April of 2023, this is basically some few days to the end of the year. So we are told Shiba Limited, which is this one, sent goods at an invoice price of 7 million to Pika Limited, which Pika Limited neither received nor recorded until 5th of May 2023. I hope you can be able to remember what is that. Automatically, that is now what we refer as the goods in transit. The goods in what? In transit. These are the goods which were sent by this company, but when the year was coming to an end, this company had not received nor recorded those goods. So we refer to them as goods in transit. The goods in transit. The goods in what? The goods in transit. Goods in transit. The GIT. The goods in what? In transit. Now, we said as far as these goods in transit are concerned, we make 3 adjustments. There are 3 adjustments which are made here. That is basically what you need to remember from our discussion. We said we make 3 adjustments. The first adjustment is basically to recognize the goods. To recognize what? The goods. That's the first thing you need to do. To recognize the goods. So these goods which were sent by this company, but when they was coming to an end, this company had not received and accounted for them. So those particular goods, they had a value of 7 million. Even before we go to the last paragraph, to the next information which is given here, the goods had a value of 7,000,000. So how do we recognize these goods in the books of account of the parent? So if the parent company had received these goods, the parent company or these goods were supposed to be part of the inventory of the parent and part of the payables because the parent company had not paid for them. So therefore, these ones, we will add them to the group inventory. That is first adjustments. And then number two, we add them to the group payables. So those are the two adjustments which will be made to recognize those goods. So if this company had received those goods, they were supposed to be part of the inventory and still part of the payables. Part of the payables. So then the other adjustment which we need to make is the adjustment for unreleased profit, because automatically this company made some profit, but automatically the entire profit was not yet realized. This company had not received those goods, so mean that the goods were not yet to be sold to the third parties. We make adjustment for unreleased, we compute the unreleased profit, and also these goods will give rise to amount of intercompany debt. But before we do that, we can go through the other information which are given in note number 2. Specifically the last sentence of paragraph 1, we are told 𝐻𝐶 Limited, which is basically the company which sold the goods, had marked up these goods at 25% on cost. And then you are told the last paragraph, the agreed trade payables record in the books of PICA, the agreed trade payables recorded in the books of PICA Limited before the above transaction of 6 million. Okay, so before we do that, let's first of all, we compute the unreleased profit on these goods, unreleased profit on the inventory. So the unreleased profit on the inventory. So because we say that these goods were not yet received by this company, so mean that the profit which was made by 𝐻𝐶, this profit was not yet realized. So this unreleased profit is by the selling company, which is 𝐻𝐶. So how do we compute this one? We take the goods in transit, we multiply that with the gross profit margin. So the goods in transit had a value of 7,000. That is the value of the goods in transit, this one, times the gross profit margin. Are we given the gross profit margin in that question? Are we given the gross profit margin? No. Whatever we are given is the gross profit markup. We are given gross profit markup as 25%. 25% as a fraction is 25% all over 100, which is basically a quarter. So if we have that as our markup, how do we compute the gross profit margin? We say this one would be equal to 1 all over 4, and then to this we add the numerator. So this one would be 1 all over 5. That is our margin. So our margin, therefore, here will be 1 all over 5. So give me the final figure here. The final figure here, which is 7,000 divided by 5. So that will give us an unreleased profit of 1,400. So this unreleased profit one will basically be deducted from the group inventory. And number 2, we also deduct this from the retained earnings of 𝐻𝐶. The retained earnings of 𝐻𝐶. So the other adjustments which we need to make as far as these goods are concerned is an adjustment for amount of intercompany debt. Remember, this company sold some goods, sent them to the parent, but basically, because this company had not received those goods, automatically it had not paid for them. So that gives rise to amount of intercompany debt. So the amount of intercompany debt automatically would be equal to 7 million. But now there is also another information which is given in note number 2, the last sentence. Can we go to note number 2, the last paragraph? We are told the agreed trade payables recorded in the books of PICA before the above transaction was 6 million or 6 million. What does that mean? It basically means that before this transaction here, before this transaction of the goods in transit, there was another amount of intercompany debt of how much? Of 6 million. So by the end of the day, the amount of intercompany debt between Sheba and PICA will be equal to the 6 million plus this other amount of 7 million. So the total amount of intercompany debt by the end of the day will be what? Will be 6 million plus now this one, 7 million. This is the total amount of intercompany debt. So this total amount of intercompany debt, this one, 13 million. This one, recall the adjustment. This one will be deducted from the group receivables and also from the group what? Payables. And remember, this amount of intercompany debt is the same. So it will be deducted from the group receivables and also deducted from the group what? From the group payables. The amount of 13 million. The amount of 13 million. So having that, we need to move to the other point. So therefore, if you come across that adjustment or that item, the goods in transit, you have to recall those three adjustments. Recognize the goods, compute the amount of the nearest profit, also they give rise to amount of intercompany debt. So number 3, we are told a PICA limited policy is to measure the non-controlling interest at fair value on the date of acquisition. We said this information is to help you compute the goodwill. NCI is to be measured at fair value. When computing the goodwill on acquisition of the subsidiary, we use the full goodwill method. We are told for this purpose, the directors of PICA Limited consider Sheba Limited shares of shillings. Sheba Limited share price of shillings 12 per share to be appropriate. In this case, we are not specifically given the NCI at fair value, but I'll be able to show you how we compute that specifically when answering part A of the question. So, but when computing the goodwill on acquisition of Sheba, we are going to use the full goodwill method. Then number 4, we are told impairment test performed on 30th of April 2024 at the end of the current year revealed that the goodwill on acquisition of Sheba Limited had not impaired. The goodwill on acquisition of Sheba had not impaired. We don't have any impairment loss. And then you're told, but due to the declining sales of Amua, which is the associate, the value of investment in Amua had been impaired to an extent of 2 million. So this is an impairment loss in relation to the investment made in Amua. So we are going to use that in answering part B. And then number 5, we are told Amua Limited reported profit after tax of 4 million during the current year. Also, that one will be used in answering part B. And then we are told number 6, assume all the profit and losses of the 3 companies accrued evenly throughout the year. So I think no workings which are required there. So what we need to do, we can go straight to answering part A of the question, basically whereby you are required to compute the goodwill on acquisition. The goodwill on acquisition of what? The goodwill on acquisition of Sheba Limited. Remember, in this case, I've said, as per the information which are given in note number 3, we are going to use the full goodwill method. We will use the full goodwill method because we are told the policy of the group is to measure NCI at fair value. We said if you come across that information, then compute the goodwill using the full goodwill method. So in this case, we need to have 2 columns. 2 columns here. So what do we start with here? We always start with the purchase consideration. The purchase consideration which was paid by the parent, company. And then to this, we will add the purchase consideration paid by the NCI. So the purchase consideration paid by the parent company, this information, we have it below paragraph 1. So let's go back to paragraph 1 of our question here. Paragraph 1. In paragraph 1, we are told PICA Limited, which is our parent, a public limited entity, intends to expand its operation by acquiring investment in other entities. In the last sentence, we are told On 1st April 2022, Pika Limited acquired or secured 75% equity interest in Shiba under the following terms. We are given the terms of acquisition. We are told an immediate cash payment at a fair value of shillings 13 per share on 1st November 2022. So in this case, we are told when the parent company acquired 75% of Shiba, there was a cash consideration. The cash what? Consideration, that immediate cash payment. Immediate cash payment, if you can be able to recall, we refer to that as what? As cash payment. And in this case, we are told the amount which was paid here is 13 shillings per share. 13 shillings per share. Now, you may decide to compute this. So basically, to compute that, we should take 13 shillings. 13 shillings, you multiply that with the shares acquired in Shiba. The shares acquired. The shares which were acquired. But there is no need of computing this because this value is given in the statement of financial position of Pika. Can we go to the statement of financial position of Pika? Specifically where we have the non-current assets. In the statement of financial position of Pika, under the non-current assets, we have PP, property, plant, and equipment. And then from there, we have investment in Shiba. Investment in Shiba, you can see we are given 6 million shares at shilling 16, at shilling 13. So meaning that the shares which Pika Limited acquired in Shiba was 6 million. So 6 million times the amount which was to be paid per share, which will give us what? Which will give us 48 million. 48 what? Million. So, and why are we told that the shares acquired was 6 million? So we can first of all determine how many shares are issued by this company. The shares issued by Shiba, you get that from the balance sheet of Shiba at the equity. At the equity, the share capital of this is 80,000. So for us to be able to know the shares issued by Shiba, we will divide that with the par value. And I hope you can see the par value where we have the word ordinary shares in the balance sheet. The ordinary shares of this company, they have a par value of 10. So the shares issued by this company are 8,000. So the shares Pika Limited acquired in Shiba was 75%. So if you get 75% of this, that basically will give you 6,000. Alan, what are you referring to, 78 or 48? Okay, so the price is okay. This one should be 78, not 48. Yes, so that one is okay. It should be 78. Yes. So therefore, the cash consideration here is 78. 78. So 13 shillings times the shares acquired. Then I want us to go back to the information we have below paragraph 1, because other than this cash consideration, in point number 2, we are told there was an issue of 3 ordinary shares of shillings 10 per value in Pika Limited for every 5 shares which were acquired in Shiba. If you can be able to recall, we refer to that as the share exchange consideration. The share exchange consideration. So for the share exchange consideration, you need first of all to remember the formula. How do we compute the share exchange consideration? The share exchange consideration. In this case, we say compute the number of shares which were issued by the parent. Issued by who? The parent company. So this one we said the examiner will not give you this one, and then multiply these shares with their fair value or market price on the date of acquisition. So this is something we are already given. In that point. In that point, we are told the last sentence of that point 2, we are told the share issue. Okay, not that point, but point number 2. There is one somewhere we are told the fair value of Pika Limited shares was shillings 13 per share on the date of acquisition. So the shares of the parent company on the date of acquisition, they had a market price or a fair value of shillings 13. That one is already given. So what we need to do is to determine this. How many shares were issued by the parent company to pay the purchase consideration? We are going to use that information we have in point 2, where we are told an issue of 3 ordinary shares of shillings 10 in Pika. So Pika here was to issue, Pika Limited was to issue 3 shares for every 5 shares which were acquired, for every 5 shares which were acquired. So in our case, do we know how many shares were acquired by Pika in Shiba? Do we know how many shares Shiba Limited acquired in Pika? Sorry, how many shares Pika Limited acquired in Shiba? Do we know how many shares were acquired by our parent company, the subsidiary? Do we know how many shares were acquired by the parent company in the subsidiary? Do we know how many shares were acquired? Do we know how many shares were acquired? How many shares did the parent company acquire in the subsidiary? How many shares were acquired? How many shares did the parent company acquire in the subsidiary? How many shares were acquired? We have already dealt with that somewhere here. Just now. Yes, we have said the shares which were acquired were 6 million. We have computed that here. We have said that this one was also computed based on 6,000 shares which were acquired. The shares which were acquired were 6,000. So what we just need to do is to cross multiply, then we divide. So therefore, the shares which were issued here will be, because we need to cross multiply, then we divide 3 times 6,000 divided by 5. Divided by 5. So this will give us 12. And basically that will give us what? That is 600. That is 600 shares. So these are the shares which were issued by the parent company. The parent company issued these shares. It issued, that is 600 shares. And then we need to multiply those shares with their fair value, which is shillings 13. Which is shillings 13. So therefore, let's compute the share exchange consideration. That is 6 times 13. So I'm getting a figure of verse 40. 46,800. 46,800. Are you getting that figure? 46,800. 46,800. Yes. So now this is the purchase consideration paid by the parent. Then to this we say, when using the full good in method, we add something called the NCI. The NCI at fair value. In other terms, if you can be able to recall, we said NCI at fair value. This refers to the purchase consideration paid by NCI. So when the minority shareholders acquired their shares, how much amount did they pay? Now, if we go back to the information we have in note number 3, we are not given this NCI at fair value. If you can remember the other question we did for Kuja 20, this value was given, the NCI at fair value. But if that NCI at fair value is not given, to compute that is quite simple, because we are saying when minority shareholders acquired their shares here, how much amount did they pay? So automatically you need to determine how many shares were acquired by the minority shareholders here. We know the parent company acquired 75% of the share. The remaining 25% of the shares are the ones which were acquired by who? The minority shareholders. The minority shareholders acquired the remaining 25% of the share. So therefore, we need to compute how many shares were acquired by the minority shareholders. 25% of the shares issued by this company. Hope you can remember, we have said that the shares issued by Shiba are 8,000. Its share capital divided by the par value. The shares issued by Shiba are 8,000. So these are the shares acquired by minority shareholders. So for us to be able to know the amount they paid for those shares, we have to multiply that with the market price of the shares on the date the shares were acquired. So automatically the shares were acquired on this date, the date of acquisition. Now, if you go back to point number 3, the last sentence, we are told for this purpose, the directors of Pika Limited considered Shiba Limited share price of shillings 12 per share to be appropriate. So it basically means that when the parent company acquired 75% of the shares, when the minority shareholders acquired 25% of the shares of these, each share had a market price of shillings what? Each share had a market price of shillings 12. So meaning that the amount of purchase consideration paid by minority shareholders was what? Was the shares they acquired, 25% of these times the market price per share. They paid shillings 12. They paid shillings what? 12. So therefore, in case you come across a question and you're not given the LCI fair value, what you do, compute the shares acquired by minority shareholders by LCI, multiply those shares with their market price on the date of acquisition. That will give you what? The purchase consideration which was paid. So this will give us 0.25 times 8,000, which basically 2,000, 2,000 times 12, which will give us what? 24,000. Yes, so in this case, we need to add all this, which is the purchase consideration paid by the parent and who? NCI. So we have 78 plus 46.8 plus 24. And this will give us 148,800. So that is the purchase consideration paid by both the parent and also who? NCI. And then to this, we proceed with less the fair value of net assets acquired. Fair value of net assets acquired. Fair value of net assets acquired. This is basically something we said the examiner will not have given you. So, but is you have to compute this. We said in this case we need to determine at the date this company was acquired, what was the fair value of its net asset? And actually we said we compute that by adding its ordinary share capital plus the pre-acquisition reserves. So therefore what we need to do here is basically to take the ordinary share capital of this company, that is of Sheba. Where do we get that? We get that at the equity section in the balance sheet of Sheba. So the ordinary share capital of this company is what? From its statement of financial position, it is 80,000. So below that, we don't have anything else, but basically what we have is the retained profit. So retained profit, or basically the retained earnings, this one we need to compute the retained earnings of the date of it was acquired. Now, if you check on this question, there is nowhere we are told we are given the retained earnings of this company on the date it was acquired. So generally, this is something you need to know moving forward. Anytime a subsidiary company was acquired during the current year, there is no single time the examiner will give you its retained earnings on the date of acquisition. But if you can remember the other question which we did for Kuja Trade, which was acquired years back, we were given its retained earnings on the date of acquisition. So, but a subsidiary acquired during the current year, the examiner will not give you its retained earnings. In very rare cases, the examiner will give you that. So you have to compute. Basically, what we know, I hope you can be able to remember that this subsidiary was acquired 6 months to the end of the year. That's what we said. It was acquired 6 months to the end of the year and automatically 6 months from the start. So what we do for us to be able to compute, because what you're interested with is the retained earnings of Sheba on this date. It was acquired 6 months from the start of the year, 6 months to the end of the year. So if you go back to the information we have in the balance sheet, when you go to the balance sheet of Sheba, specifically at the equity, you can see we are given the retained earnings of Sheba at the start of the year. That is on 1st May 2022. 1st May 2022 is at the start. We are given the retained earnings of that company at the start of the year. The retained earnings of Sheba. Remember, you're interested with Sheba at the start of the year here, which was 12,800. That is the retained earnings of Sheba at the start. And then we also given the profit for this year, the retained profit for this year for Sheba, which is 10,800. So the reason why you're given that information is for you to be able to compute the retained earnings of Sheba on this date here. This date. How do we compute the retained earnings on the date of acquisition? Very, very simple. We take the retained earnings at the start of the year, this one, which is 12,800. And then to this, we add the profit, which was the retained profit for this period, for these 6 months. because we're interested with the retained earnings of Sheba on that date. So how do we get the retained earnings for the first 6 months? So we will take the retained profit for the whole year, which we also given as 10,800, and then we apportion this on time basis. We multiply that with 6 over 12, so that we know the retained earnings for the first 6 months. So once we take this plus the retained profit for 6 months, we will be able to get the retained earnings of Sheba on the date it was acquired, that date there. So this will give us 12,800 plus basically half of this, which is 5,400, and this will give us what? This will give us 18,200. 18,200. Are you getting 18,200? 18,200. Yes, that will give us 18,200. And basically, that is the retained earnings of Sheba on the date it was acquired. So therefore, anytime a subsidiary was acquired during the current year, the examiner will not give you its retained earnings on the date of acquisition. You must compute that. So that is basically the only reserve which we have within the balance sheet of Sheba. Then from there is something we said you must always remember to check whether the subsidiary company revalued assets on the date of acquisition. If yes, was there revaluation gain? And I hope you can be able to remember on the date Sheba Limited was acquired, it revalued an item of asset, and there was a revaluation gain of 10,000. This one. So that one we recognize it here. We recognize that there as a pre-acquisition what? Reserve. And basically in our case, we don't have anything else. So what we need to do is basically to get this total. To get this total, so let's add all those figures. We have 18,200 plus 10 plus 80. This will give us 108, 200, 108, 200, 108, 200. And in this case, remember, we're interested with the goodwill of the parent and the goodwill of the NCI. So what we do here, we take the net asset acquired by the parent and the NCI. The net asset acquired by the parent and the NCI should be 100% of this. So 100% of this is 108, 200, which basically will be less from the figure we have up there. We take 100% of that. So we less that from 148, 800. And this will give us a figure of 46 what? 600. 4600. So this is what? This is the goodwill on acquisition. The goodwill on acquisition. And remember, the information which are given in note number 4, we are told that this goodwill is not impaired. The goodwill has not lost any what? Any value. So that is basically the amount we are going to take to, we are going to recognize in the statement of financial position as a non-current asset. So this is what was required in part A of that question. And basically by doing this, the marks are located here. Basically were 4 marks. So let's move to part B of that question. Part B. So in part B, what are we required to do? We are required to compute the value of investment in 𝐻𝐶 Limited. So this is part B, value of investment in 𝐻𝐶 Limited. In other terms, what we are required to compute here is something called the investment in associate. Remember, 𝐻𝐶 Limited is an associate. We are required to compute the investment in associate. So, and what we just need to recall is the format which I've just given you. How do we compute the investment in an associate? I've said we take the cost of investment, or the purchase consideration, and then to this we have said we add the group share of post-acquisition retained earnings, and any other reserve. And I think in this case, this associate do not have any other reserve other than the retained earnings. And then to this we less what? any impairment loss. Any impairment what? Loss. This one is quite simple because everything is provided here. I think we can start with the impairment loss, this one, which is given in note number 4. In note number 4. In note number 4, we are told that impairment test performed at the end of the year revealed that the goodwill on acquisition of Sheba was not impaired. This one had not impaired, but due to declining sales of Amua, the value of investment in Amua was impaired by 2 million. So we have an impairment loss here of 2 million, which basically we less here. So what about this one? So we know that this associate was acquired 6 months to the end of the year. So if we go to note number 5, we are told Amua Limited reported a profit after tax, which is the same with the retained profit of 4 million for the year. During the current year, this company reported a profit of 4 million. 4 million. And taking into account it was acquired 6 months to the end of the year, we want to know how much profit will the parent company be entitled to share. We will take the profit for the whole year, 4 million. But in our case, we're interested with the profit from the date Amua was acquired. Amua was acquired 6 months to the end of the year. So we compute the profit after Amua was acquired, and that is what we refer to as the post-acquisition retained earnings, which will be 6 months to the end of the year. We multiply that with 6 over 12. We get the profit for the last 6 months, and then we get the parent company share of that. The parent company share of that will be equal to 30%. Will be equal to 30%. So let's work out that, which is basically quite simple. Half, which is 2,000. We multiply that times 0.3. And that will give us what? That will give us 600. That will give us 600. Then this one is given. This one is given. So we go to the balance sheet of the parent, the balance sheet of parent and the assets. How much amount did the parent company invested in Amua? So that is given in the balance sheet of Pika under the non-current assets. The amount invested in Amua is 24,000. 24,000. So you can see this one was quite simple because almost everything was given. So we compute now the investment in associate. 24 million plus 600 minus 2,000. So that will give us 22,600. 22,600. I hope that is what you're getting. I hope that is what you're getting, yes. And basically by doing that, equally the marks allocated there are 4. So let's move to the last part of the question, whereby we are required to prepare the consolidated statement of financial position, basically for the year, which ended 30th of April 2023. 30th of April 2023. 30th of April 2023. 30th of April 2023. So Aaron, you're asking about what? How did you get 20,000 revaluation gain on part? Where do you have revaluation gain, Aaron? Do you have a revaluation gain somewhere of 20,000? I can't see that. I can't see any revaluation gain of 20,000. I can't see a revaluation gain of 20,000. So maybe retype your question again. Retype your question again of 10,000. This is what we dealt with here, Aaron. Check what we did in working one. Working one. And basically, can you try to see what we did in the other question? If you can be able to recall what we did in the other question, we are doing the same thing here. We are doing the same thing. So try to understand those concepts which are in all questions, especially this one. This one, you must understand this. This is in all questions for group account, fair value adjustment. So let's prepare this one. And basically, how do we prepare this? I want us to do this in the next 20 minutes. How do we prepare this one? we prepare this basically by combining similar items of assets and liabilities, those of the parent, those of the subsidiary. And that's why in this case, for example, you can see even the examiner has not given you the asset and liabilities of who? Of associate, because we don't consolidate an associate. What we include here as far as the associate is concerned is what we have computed here. Yes, so we only add assets and liabilities of the parent, those of the subsidiary. The other thing which is also important for you to note is that even if this subsidiary was acquired 6 months to the end of the year, we don't do what? We don't apportion asset and liabilities on time basis. So apportionment only applies to revenue and expenses. So we have to take the full amount of asset and liabilities of the subsidiary, even if it was acquired 6 months to the end of what? Of the year. So let's do that. So here, we will start with the non-current assets. So I will take the PPE and basically take the PPE of the parent, 135, plus the PPE of the subsidiary, 100, 400. And then to this, we need to check, do we have any adjustment affecting the PPE? Yes, this working one. Working one, this revaluation gain, we said we added to the PPE. And then number two, we have this depreciation under charge of 500, which we said we less from the PPE. So two adjustments here. We add 10,000, the revaluation gain, and then we less what? We less 500. No any other adjustments. No any other adjustment. We get the final figure. We have 135 plus 100, 400 plus 10 minus 500. And I'm getting 244, 900. 244, 900. So below that, please confirm whether you're getting the same figure. So below that, we have investment in Shiba, investment in Amua. Do we include those items here? The purchase consideration paid in acquiring shares of Shiba and Amua? No. Instead, the investment in Shiba has been used in the computation of this goodwill. So what we include here in relation to Shiba is the goodwill on acquisition of Shiba Limited. How much is that? 4,600. That is basically what we include here. In relation to Amua, we include what we have computed here. The investment in Amua. The investment in Amua, what we have computed here, 22,600. That's basically what we include here. And I think in our case, we are done with the non-current assets. So we need to proceed and basically record the current assets. So for the current asset, I will start with the inventory. So for the inventory, I will take for the two companies, I combine them, and then I make the necessary consolidation adjustment. 28,400 plus 12,100. And we said we have a number of adjustments affecting that. One, we have this goods in transit. Goods in transit. We said this 7,000 will be added to the group inventory. And then we have this unreleased profit over 14, which we said we also left from the group inventory. So two adjustments to be made here. So we add 7,000, the goods in transit, this one, and then we do what? We left this unreleased profit of 14. We left that unreleased profit. We get the final figure, So we have 28,400 plus 12,100 plus 7 minus 14. So which will give us 46,100. Okay. So below that we have what we have the trade receivables. We have the trade receivables. The trade receivables, I'll do the same. I'll take the trade receivables of the two companies, I combine them, 27,500 plus 19,900. And then I check, do we have any adjustment here? Yes. We have this adjustment for amount of intercompany debt, 13, which will be deducted from this group receivables. I only have this adjustment here. That no any other adjustments, so we get the final figure 27,500 plus 19,900 minus 13. So which will give us 34,400. So then finally we have the cash and cash equivalents. So we add for those two, for the two companies, that is basically 10,600 plus 68 plus 68. Do we have any adjustment affecting this? No, because we don't have any cash in transit. We just need to get the total. We just need to get the total. So that will give us 17,400. 17,400. And then what do we need to do? We need to get the total assets. So the total assets, we add all this. We have 17,400 plus 34,400 plus 46,100 plus 22,600 plus 46 plus 244.9. So in this case, I'm getting 406. I'm getting 406, 406, 406, 406,000, 46,000, 46,000. I don't know whether you're getting the same. So you can do away with this to create space here. Yes, someone to confirm whether you're getting the same. Yes, that is confirmed by Juliet. Okay, so then from there we proceed and record equity. So that is share capital and reserves. So at the equity, we will start with the ordinary share capital. Ordinary share capital. In this case, we say for the ordinary share capital, we record that of the parent company only. The ordinary share capital of the parent, in this case, will be 160,000. But in this question, the ordinary share capital of the parent will be having an adjustment. We said whenever the parent company has paid some purchase consideration by issuing shares, those shares which were issued by the parent company, they were not accounted for. And basically, we said the shares issued will affect the ordinary share capital and the share premium. So, and how many shares were issued by the parent company, the payment of purchase consideration? We computed those shares. In our computation of the purchase consideration, did we say the parent company issued, were they that 600? Because the parent company was to issue 3 shares for every 5 shares acquired. The shares acquired was 6,000. I think we multiplied this. So this was 3 times 6,000 divided by 5. And I think this was coming to 36. Yes. The shares issued by the parent were 36. Now, what do we add here to the share capital? The amount we add to the share capital is an amount equal to the par value. So the par value of these shares, would be 36 times the par value per share, which is 10, So that will increase this. So this will be 36,000 times this, which will give us 196. And when the parent company issued these shares, what was the market price per share? Ile market price tumetumia ku compute purchase consideration. Was it it was 13, Was it 13 shillings? 13. So the amount which is above 10, and basically that is 3 shillings, that is a share premium. So belonging to the parent. So in relation to these shares which were issued by the parent, tutakuwa na share premium ya 36 times what? Times 3 shillings. Times 3 shillings. Times 3 shillings. That will give us what? That will give us what? That will give us then 800. That will give us then what? 10,800 is the share premium of the parent. Yes. So then from there, there is something we said which must be computed here, which we said this is one of the items which is quite demanding, and that is the retained earnings. And I think moving forward, there are those items. In fact, because we said even in an exam setup, these are items you don't need to compute. Like this one, the retained earnings, because we said by doing this, it's not a must you have to get everything correct. Yes. So maybe first of all, you can skip this. If you're going to have some time, we will compute. But this is an item I'll not advise you even in an exam, never bother yourself computing this. The other item we also need to compute and we include here is basically something called the non-controlling interest. Also, we will compute that if time will allow. But let's first of all proceed and record the liabilities. We will be able to compute that. So these are two items which are quite demanding. So the non-current liabilities, I will start with there are actually two. We have 10% bank loan, 10% bank loan. No adjustment for this. We just add that of the parent and that of the subsidiary. This will give us 35,000. No adjustments there. Below that, we have deferred tax. We said anytime you come across a component for tax, also this is a pre-mark. No adjustment. We just add 37 plus what? Plus 31, which will give us 68. No adjustments here. Then we go to the current liabilities. For the current liabilities, we will start with the trade payables. Trade payables, we add that of the parent, 28,800, plus that of the subsidiary, which is 21,200. And then now to this, we have, I think, two adjustments affecting the payables. One, we have these goods in transit. This amount of 7,000, we said we added to the payables. So to the payables, we add 7,000. And then I hope you can also be able to recall we have this amount of intercompany debt, 13. So to be deducted from payables. So be also less 13,000. So those are the only the two items to be adjusted to the payables, So let's get the final figure here, which is 28,800 plus 21,200 plus 7,000 minus 13. So I'm getting 44,000. 44,000 like that. 44,000 like that. And then finally, I have current tax. Current tax, we said, being a component of tax, this is also another free mark. So you have 19 plus what? Plus 13. Plus 13. This is also a free mark. And basically, this will give us what? This will give us 32. This will give us what? 32. This will give us 32. Then we will get the total equity and what? The total equity and liabilities. The total equity and what? And liabilities. The total equity and liabilities. Do we need to compute these two items or we can just leave them? Do we need to compute them or we can just leave them? Because like this question, by doing that, we'll be able to get all the marks, even without necessarily coming back to compute these two items. I hope you can be able to recall the other question which we did, the computation of these two items. We said we were able to see that it is basically quite demanding. But basically, once we're able to do this, you'll be in a position to score all the marks. You'll be in a position to score all what? The marks. You can see the marks allocated there are 12. In most of the cases, this is how the marks are allocated. For every 6 correct entries, you are given 2 marks. You're given 2 what? 2 marks. For every correct entry, here you get how many marks? You get 2. You get 2. It basically means that it's not a math. You have to get everything correct. Everything good? Correct. Sasa? Yes. So easy 2 items. I think we can just leave them. No need of computing them. You'll be able to see that even during our revision, kuna zile vitu tutakuwa tuna compute. Naambia kwa mtihani na this one, you don't need to compute that. It will basically consume a lot of your time, and you don't have to compute some of those items for you to be able to get all what? All the marks. All what? The marks. Now, I want us to stop at that point for today. I want you to have a short break before you start the other class. We stopped at that point for today. There are so many questions from the past papers. I want us to do another one question in our next class. Then after doing that, we will wind up with this topic, but we will be able to come back to this topic during our revision because there are like 2 topics, not big topic. We have a topic on borrowing cost. Will just take us 1 class and a topic on conversion of partnership into a limited liability company. I think majorly those are like the computation topics which are remaining. Before now, we start our revision and we look on some theory topics which are remaining. So right now, I said we are almost 90% done with the syllabus, 90% done. I'm hoping that actually by next week, because on Tuesday we will be able to do one question on this. We will be able to see whether we can be able to do two. If we can be able to do two, that will be very good for us. We see whether we can be able to do two questions. We wind up with this, and then from there, our next class on Thursday, God willing, we should be able to do borrowing costs, and then we start on. I think let's start with the conversion of partnership on Thursday, which we should be able to finish on Saturday, and it basically means that by the other week we will be having, I think, one computation topic, which will be remaining. Though there are other theory topics which will be remaining, which I think we will be able to create time and basically go through them. So therefore, I'm saying right now, I think we are over 90% done with the syllabus. Remember what we agreed by 21st, we should be able to embark on revision. We should be able to embark on what? On revision. Sasa? Yes. So maybe you can check on the question which was Taylor sitting or any other question. We will pick a question having 3 companies: parent, associate, and also a joint venture, or basically that is parent, associate, or joint venture and a subsidiary, and basically a question requiring the preparation of consolidated statement of profit or loss and the consolidated statement of financial position, so that we finish on this work on this topic. So let's stop at that point for today. We continue from there in our next class. So have a nice weekend. See you next week. Here. Of December 2022. So basically, these are a list of balances. Remember, in this case, you are an auditor, or basically you are auditing this particular company here, and you're given these particular balances. We have the capital, we have the revenue, the trade payables, the return outward, expected credit losses. Remember, in this case, I said when talk about the expected credit losses, these are the expected doubtful debt. Now, currently, I said the word which is used is expected credit losses. Nowadays, we don't talk of the doubtful debt, but we talk of the expected credit losses. And basically, what we have here, this is what previously we used to refer to as the allowance or the provision for doubtful debt. This is now what is known as the expected credit losses at the start. Below that, we have the discount allowed, discount received purchases, return inwards, distribution cost, drawings, rent rate and insurance, teaching and writing, postage, stationery and telephone, advertising, salaries and wages, credit losses. Remember, even the question we did yesterday, there is a question we did for taxation. We came across this word here, credit losses. Credit losses, I said, these currently, or basically this previously what we used to refer to as the bad debt written off. Do we still talk of bad debt written off? No, we talk of the credit losses. So credit losses is equivalent to the bad debts which were written off. We have cash in hand, cash at bank. We have inventory at the stand. We have trade receivables, property, equipment, and furniture at cost, accumulated depreciation, and okay, so what is this now? What is this? Basically, I'll be able to confirm what is this. Okay, so I hope I'll be able to get the original question because I need to confirm what is that. So then we have the depreciation. The depreciation, maybe if you are in a position to access the original paper, if you're in a position to access the original paper, so I'll be able to confirm this. Maybe you can tell us what is this? What is this? What this D is? Because basically we need to know what is that. So if you're in a position to access the original papers, please maybe you can tell us. You can tell us what is this? What is this? So let me see whether I can be able to get those papers in my phone. Yeah, so let me confirm. Okay. Okay, let me see. Okay, so I'm told by Judy, this is accumulated depreciation. Yes, okay, thank you, Judy. Yes, I think also I've seen, have I seen, yes, I think I've seen this. Yes, so this is basically the accumulated depreciation at the end of the year. Is that the position? Yes, let me change this to accumulated depreciation on 31st of December 2020 when the year ended 2022. 2022. I hope that is then correct. I hope that is correct. Yes. So I'm told this question is for April 2023, not April 2024. This is April 2023. April 2023. I also need to change this one. Should be April 2023. Thank you for that. Okay, so we have that accumulated depreciation. So another item has disappeared here. Oops. Let me just a minute. Which expense was this one? This was which expense? Which expense was this? Below heating and lighting. I think equally you can be able to counter check. I don't know whether the original paper which I shared, it has those details in the class WhatsApp group. Which expense is this one? Or which item do we have below heating and lighting? Below heating and lighting, what do we have? Someone to confirm for me. Judith, which is below, okay, sour. Yes, I think we have interfered with our original document here. Let me. Yes, so that should be postage, stationery, and telephone. That is basically an expense. Okay, so then we are given basically those particular balances, and then you're told as you begin the audit process, you discover the foreign adjustment that should be made to finalize the financial statement as you carry out the substantive test. I hope you can be able to remember what are substantive tests. Substantive tests, these are basically detailed audit tests to be undertaken in the books of account, including the account balances. So we are given some adjustments. So we are given the closing inventory. We have insurance, which was prepaid. We have heating and lighting accrued. We have prepaid rates. We have end-year credit losses, or the end-year expected credit losses is estimated at 1 𝐻65,000. Remember, this is now like the provision or allowance for doubtful debt at the end of the year. I hope you can be able to recall how we used to account for this in financial accounting. So then we're also given errors through commissions. So we are told an invoice for goods sold was not posted. So, and basically what this requires, for you to be able to answer this question comfortably, you must be very much okay with financial accounting, because this is all about financial accounting. For example, in this case, once we are told an invoice for goods sold was not posted. So how should we account for this? This is quite simple, because once you sell goods on credit, you issue an invoice. So that invoice which you have issued, what is the double entry for that? Automatically we debit the receivables, we credit the revenue, or we credit the sales account. You can see that here the issue is double entry. Number two, drawings of goods not reflected in the drawings. So drawings of goods, how do we account for that? We debit the drawings account, we credit purchases. Number three, an additional credit loss omitted. These are additional bad debts which were written off. So how do we account for this? This one will be debited, will be added to the credit losses already written off, and deducted from payable. We are also given the depreciation expense for the year is understated with 120,000. So what are we required to do here? We are required to prepare an audit schedule for 8 columns with the following headings. 1, the original trial balance without adjustment. Roman 2, adjustment. Roman 3, the draft profit or loss item. Roman 4, the draft statement of financial position. Each section should have the debit and the credit column, and which is jure balance. You can see this question is similar to the other one which we did, but you can see this question is having now some additional items. So what we basically we need to do here is we split our worksheet into two, or Excel worksheet into two. So basically, this will be our solution. So this is an 8 column. This is an 8 column worksheet. And basically this 8 column worksheet, we are required, or we are given the sections to be included. The sections to be included here. So automatically we are going to start with the details column. We will start with the details column. Then from there, we can have the original trial balance, because I hope you can remember we are given the sections to be included here. The first one should be the original trial balance. Maybe I can just copy this one. The original trial balance. Let me just copy this one. Original trial balance. Maybe I can have that from here. That is the original trial balance. So, and then in this case, in the original trial balance, remember, we need to have 2 columns in each section, the debit and the credit column. Then we will have the other section, which is basically the adjustment column. And in this case, we will equally have the debit and the credit column like that. And then from there, we will have the statement of profit or loss. Statement of profit or loss. And then finally, remember also here we need to have 2 columns, the debit and credit. And finally, we will have the statement of financial position, which was formerly known as the balance sheet. Equally here, we need to have we need to have two columns like that, two columns like that, two columns like that. And then I hope you can also see the figures we're given here are in thousands of shillings. So we equally up there, we need to indicate all our figures will be thousands of shillings. So I need to copy this one. I'll copy that and basically paste that across. So paste, control V, yes, like that. Then I think I need to split this. This will be this will be our original trial balance. The adjustment section, our statement of profit or loss, our statement of profit or loss, and finally, we have the statement of financial position, statement of financial position like that, like that. So maybe we can make this one a little bit, we can expand this. Yes, so I think now we can move and basically we start by preparing the original trial balance. So how do we prepare the original trial balance? We prepare the original trial balance basically from the balances which we have here. From these balances which we have here, these are the balances we use to prepare the original trial balance. So what we need to do, first of all, I will pick these particular balances, or I pick these particular items, not balances, all these items, all of them, I'll copy them. I copy them and then I transfer them here. Basically from here, I paste them here, Control V. Okay. Let me copy them afresh. Control C. And then I need to paste them here, Control V, like that. Yes, Control V. Now, basically what I need to do is to bring these particular items, or actually, you can see these balances which are given here. They are not arranged within our trial balance. But I think I said that once you're given a number of balances, you need to know each item, each of these balances will go to which side of the original trial balance. Will it go to the debit or the credit side of what? Of the trial balance. And I think there is something I gave you yesterday. There is a certain acronym I gave you yesterday, and the acronym is what? Is DIDA. The acronym is DIDA, D for drawings, that is capital D for drawings, and then E for expenses, A for assets. We said all these items in the trial balance, they have a debit balance. That is the first thing you need to remember. And I hope you can be able to hear me. I think my mic have gone off. Let me just confirm here. Yes, so can you confirm whether you can hear me, whether Morimo is audible? My mics have gone off. Am I clear? Am I audible from your side? I hope my sound may not be that clear, but you should be able to hear me. Okay. So let's basically continue here. Let's continue. Let's continue. Yeah. So I said that these three items, that is drawings, expenses, and assets, all these items, they have a debit balance within the trial balance. That's the first thing you need to remember. They have a debit balance within what? The trial balance. And then we have the other three items, that is L, which stands for liabilities. And then we have E, which stands for equity, that is share capital and reserves. And then we have R, which stands for revenue, or basically incomes. We see that all these particular items here, they have a credit balance within what? The trial balance. They have a credit balance within what? The trial balance. So if you're able to remember these, then you should be able to prepare the original trial balance. The original what? Trial balance. The original trial balance. That basically the first thing we need to do. Let's therefore, first of all, we come up with the original trial balance. And actually, we are going to use these particular items here. And I think, first of all, we can do away with these particular zeros. We can remove these decimal places. We just need to come here and we reduce. We do away with those decimals like that. Yes. Now, we start with the first item of capital. This item of capital, it has a credit balance. So this one will go to the trial balance on the credit side. On the credit side like that. Revenue will also go to the credit side, because this is an item of income. So below that, we have payables, is a liability. It will go to the credit side. Below that, we have expected credit losses. Expected credit losses, this is a provision. This money which is set aside to cater for those particular debts which will not be paid in the future. So these are provision. Anytime you're given a provision for depreciation, the provision for expected losses, all provisions, they have a credit balance. So this will go to the credit side. Okay, before we do that, let's post this one, but there is an item we have skipped. So all items, all provisions, they have a credit balance, but there is an item which I've skipped here. That is the return outwards. Now, first of all, which is the other name for return outwards? Return outwards has another name. Who can remind us the other name for return outwards? Return outwards. Return outwards. Return outwards. Who can be able to remind us the other name for this? Return outwards. Let me see. Let me see whether you can be able to remember what you did in financial accounting. Return outwards. Return outwards. Return outwards, I'm told by 𝐻𝐶, sales return. Is that the position? 𝐻𝐶? No. That is not the position. That is not the position. That is not the position. Return outwards is basically what you have purchased, but you return it out, or you return it back to your suppliers. So the return outwards, basically, this is the other name for purchases return. This is the other name for purchases return. It's very, very important for you to remember that. This is another name for the purchases return. The purchases return. Now, the purchases return, basically, this one reduces the purchases. Remember, purchases, this one is basically an expense. All purchases, or basically purchases in the trial balance, this one should be recorded in the debit column because it's an expense. And therefore, these purchases return because they reduces the purchases. This one should also go to the trial balance on the credit side because this one reduces the purchases. In the trial balance on the credit side, I think we have dealt with the expected credit losses. Discount allowed, this one is an expense. Once you allow discount in your business is an expense, it will go to the debit side of the trial balance. Discount received is an income. It will go to the credit side of the trial balance. The discount received, this one, is an income. Then from there, we have purchases. This is an expense. It goes to the debit side of the trial balance. Below that, we have return inwards. The return inwards, this now is what in other terms we refer to as the sales return. The sales what? The sales returns. The sales return. The sales return. Now, the sales, basically that one go to the trial balance on the credit side, the sales. And the sales return or the return inwards, because it reduces the sales, this one should go to the debit, to the trial balance on the debit side. On the debit side, because this one should reduce our sales. Distribution cost is an expense. It will go to the debit side.
Drawings, this one, as per the acronym DIRA, this one go to the debit side. Then we have the rent insurance. Rent rate insurance is an expense, go to the debit side. We have heating and lighting is an expense, go to the debit side. Postage, stationary, telephone is an expense, go to the debit side. Advertising is an expense, will go to the debit side of the trial balance. So below that, we have the salaries and wages, go to the trial balance on the debit side. We have the credit losses, the bad debt written off is an expense, go to the debit side. Cash in hand is an asset, will go to the debit side. Cash at bank is an asset, still go to the debit side. The inventory at the start is an asset, will go to the debit side. The receivables is an asset, will go to the debit side. Property, equipment, and furniture is an asset, will go to the debit side. How much is that? Is that amount? And then we have accumulated depreciation at the end. Accumulated depreciation at the end is like a provision for depreciation. If provision has a credit balance, this will go to the credit side. Then in this case, we are given the depreciation for the current year. The depreciation for the current year has already been computed, is an expense, go to the trial balance on the credit side. So those are the balances which were extracted from the trial balance. And if everything is given here, this original trial balance should balance. This original trial balance should do what? Should balance. So let's do that. We get the totals here, down there. We see whether it will balance. The trial balance balancing? Yes. You can see our trial balance is what? Is balancing there. Our trial balance is balancing. Our trial balance is balancing. That is basically the original trial balance. It is balancing at the amount of 221, 143, 143. So that is the first segment, or the first word, the first part of that question. We prepare the original word, the original trial balance, the original word, the original trial balance. Now, after preparing that original trial balance, then we are required to make the adjustment. And I hope you're together up to that point. Is there any question up to that point regarding what you have done? Any question up to that point? Any question up to that point? Okay, none. So let's move and we make now the adjustments. We make the adjustment. Remember, we said that the adjustment basically refers to the earlier adjustment. Now, these are the balances which were extracted in the trial balance, but basically we said at the end of the year when preparing the financial statement, you need to make a number of adjustments. You need to adjust some of these particular what balances with things like the prepaid expenses, the accrued expenses, and maybe an error which was made. So in our case, we are told here, as you begin the audit, you discover the following adjustments that should be made to finalize the financial statement as you carry out the substantive test. So we are given a number of items. So we will start with the first one, which is basically the closing inventory. I will copy that and I will have it here. Remember, these are the adjustments. I will just I can note that these are the adjustments. These are the adjustments. So the first item is the closing inventory. The closing inventory is the closing inventory. Now, the closing inventory, if you can be able to recall what we said yesterday, this one will not affect any of the item within our original trial balance. So none of the item within the original trial balance will basically be affected by this word, will be affected by this closing inventory. So therefore, what we said, this closing inventory, we will take it directly to the income statement and also the statement of what? the statement of a position. And I hope you can be able to recall the format or basically the formula with which we were able to discuss. I think we can just have it here again. So remember, you said that when preparing the statement of profit or loss, we prepare it to compute the profit, or basically the loss for the year. The profit or the loss for the year. How do we compute the profit or loss for the year? We take the sales, in other terms, what is known as the revenue. We minus the cost of sales, the cost of what? Sales. But basically, in our case, how do we compute this cost of sales? We can come up with a formula. Compute the cost of sales. We take the opening inventory. This we add purchases. And because in this question we have purchases return, we will also incorporate that within our equation. But if you can remember the other question we did, because we didn't have purchases return, we never captured that in our equation. So the purchases return, P and that should be deducted from the purchases. That one should be deducted from purchases, and then to this we less the closing inventory. That is how we compute the cost of sales, and then we get the gross profit. This gross profit, we said we add other incomes. We get the total incomes, and finally less the expenses. We less the expenses like that. And I hope you can also be able to remember in this question here, we have sales return. When do we deduct the sales return? The sales return, this one should be deducted from our sales figure. So to this, we will less the sales return, or in other terms, the return what? Inwards. Return inwards. So I want us to come up with the final figure for computing the profit or loss. So the profit or loss will be equal to the sales. I can just use S for sales minus return inwards, and then I need to open this bracket and multiply everything here with the -1. So we will have minus opening inventory minus purchases. Once we multiply a negative and a positive, it will become negative, minus purchases, and then minus 1 times purchases return, which will become plus purchases return, and then this minus times minus, it will become positive, closing inventory. So we are done, and then to this, then we will take the other incomes, and then to that finally we less what? We less the expenses. So this is of profit or loss, because we said all the items here which are basically positive, those items which are positive within our equation here, those items which are positive, we record them on which side? Okay, that is one is reflected as recognized as a function. So those items which are positive, we take them to the statement of profit or loss on the credit side. That's basically what we said. Those items which are negative, need to know. So therefore, the closing inventory, remember, we have said that will not be adjusted within or will not affect any of the item in the original trial balance. So therefore, this one, number one, we will take it to the statement of financial position. The last part of this 8-column worksheet. So, and basically that one we take it to the last column here is an asset. So being an asset, we record it on the debit column, because also I hope you can be able to remember when preparing this statement of financial position, what do we record on the debit side? On the debit column, that is. On the debit column here, we said we record assets. We record assets. That is what we record on the debit, column, and then on the credit column we record equity and liabilities. Equity and liabilities. That basically what we said. So that is what you need to remember. Yes. So let's record this closing inventory here. First of all, as an asset, it is that amount. Then number 2, where do we record it in our statement of profit or loss? As per this equation, you can see closing inventory is a positive. Being a positive, it will go to the credit side. It will go to the credit side of the statement of profit or loss here. It will go to the credit side there. So we are basically done with that item. So the other one is prepaid insurance. Let me just copy this one. I copy this prepaid insurance. I bring it here. I paste it. So the prepaid insurance, this will go to the adjustment column, because I hope we can remember in this particular original trial balance, we have such an expense. That is insurance. Where do we have insurance here? The insurance is part of this. And because we have a prepaid insurance, it basically means that included in this figure is an amount which was paid during the current year, but it related to the following financial year. So therefore, number 1, we are going to deduct that amount from here. So to reduce this one, we will come to this adjustment column. And basically we do what? We do what? We credit. So in this row here, we will credit the rent, rate, and insurance with that particular amount. How much is the amount? So we take that amount directly up there, 560. So you can see we have credited the rent, rate, and insurance basically to reduce that. And then we said we must complete the double entry. So meaning that here we also need to debit. We need to debit the adjustment. Section. So the adjustment section, is that what you have done? It should be here.
July 21st to August 18th.
Should be here. Okay.
The countdown.
So let me check this particular amount here. Yes. So then from there we have writing which were accrued. So these are the expenses which were not yet paid. So this one we need to add it to this amount here, because out of this there was an amount which was not yet paid. So we add it by debiting this account. So how much is the amount? Is 680. Then from there, because we have debited this, the adjustment column we credit an equivalent amount. We credit an equivalent amount of 680. So then from there we have the prepaid rates. So let's copy this prepaid rates. So prepaid rates, basically these are rates which were paid in advance. So, and I think rates are part of this one. So we need to reduce this. So I think what we will need to do here, because you can see there was another amount which was prepaid, I think we will record the total here. We record the total. So the total here should be 560. This one 560. Where do we have that? 560 plus. No, this one. Let me do away with that formula. Or I need to remove this figure. Yes, I will take this one 560, and then I will add. Okay, I will add this one, the prepaid rates, and basically I'll get the total. So the total prepaid insurance and rates is basically the amount of 32,77,500. So basically what I've done, I've credited that account with the total amount with this prepaid insurance and the prepaid rates. Then for the prepaid rates, because we have credited that account, we need to debit it here. So this one will be debited here, so that we complete the double entry. We complete the double entry. Then from there we have the expected credit losses at the end of the year. I've said the expected credit losses at the end of the year. This is the same with the provision for doubtful debts at the end of the year, because this previously what we used to refer to as the provision or the allowance for doubtful debts at the end of what? Of the year. Now, how much amount is that? It is 1865,000. Now, remember, basically what we do is that for this particular amount, or if you can be able to recall what you used to do in financial accounting, you used to compare the allowance for doubtful debts at the start and the allowance for doubtful debts at the end of what? Of the year. And basically the increase or the decrease was the one which was taken to the income statement, allowance or with the expected credit losses at the start. The expected credit losses was this at the start. What about at the end of the year? At the end of the year, it has increased. It has increased. So basically what we need to do is we are going to increase this one with the difference. So this one, we are going to increase it to that amount which we have. So what is the difference? Maybe I can just compute it here. I will take this one, the expected credit losses at the end minus the one at the start. This one. So that is increasing with this 608. Now we are going to increase that with 609, not 608. And basically this amount then, we also put it here. We also put it here so that we complete the double entry. And basically, I think specifically we can refer to this, or what you have accounted for here is the increase. Is the increase in the expected losses. The increase in expected losses. The increase in expected losses. The increase in expected losses. Okay. So I'm saying, someone is saying, pardon. So I'm saying that this particular expected credit losses, this previously what we used to refer to as what? The provision for doubtful debts. The provision for doubtful what? Debt. So basically what we do as far as the provision or allowance for doubtful debts is concerned, what we account for during the current year is the increase or the decrease. The increase or the decrease. So and in our case, we are saying this amount increased with 609. So if it is an increase, we are saying we should increase this. Yes, I can see I've made a mistake because increasing this, yes, to increase is correct because you can see this account is credited. So if we want to increase this, we credit that with the increase. So if we credit this with the increase 609, we will increase that now to the amount which we have here. The amount which we have here, that is 1865,000. 1865,000. 1865,000. I hope that is the same accounting treatment we made for the other question we did yesterday. Is that what we did? Yeah, for the other question we did yesterday. We made the same adjustment. We made the same adjustment. But I think in our case, we were not given the allowance for debt or the expected credit losses at the start. Are we given at the start? No. So we were not given at the start. That's why you can see in this one, there is a slight difference because we have at the start, at the end. So what we account for during the current year is the increase. We will increase this with 609. I hope that is now clear. Is it clear? So now clear. Is it clear? So that we move to the other item. So that we move to the other item. Is it clear? Is it clear? Is it clear? Okay, so let's move to the other item. And I think we are done with this particular area adjustment. So then we are given some omissions or basically errors. So in this case, we just need to know how were these errors supposed to be corrected. How do we correct these particular errors? So the first error we are told an invoice for goods sold was not posted. This is basically an error. So this is an error. An invoice for goods sold was not what? Posted, was not posted. So a company have that here. We have that here. Yes, an invoice for goods sold was not what? Posted, was not posted. Now, remember what we need to do this one. We need to effect a double entry. A double entry for this will affect what? Will affect sales, will affect receivables. Sales and receivables. So take into account it will affect sales and receivables. Number one, we need to increase this. How do we increase sales? We increase sales by crediting sales. We will credit sales. So the sales account with an amount of how much? With an amount of this one. That one, we enter that. And then we do what? We debit receivables. We debit the receivables. Where do we have the receivables? We have the receivables somewhere here. We have the receivables somewhere here. Where do we have the receivables? The receivables are here. So we debit this. We debit this. We debit this. We debit this. We debit that. And in fact, I don't think we need to record the details here, because you can see by the end of the day, that will not be recorded in the adjustment column. It will not be recorded in what? The statement of profit or loss, or what? The statement of financial position. But let's just record it here. But basically that one will not be recorded anywhere here, because we just need to effect a double entry. We increase our sales, we also increase our receivables with that particular amount. Yes. So then from there we have the other error which was basically made. So we are told drawings of goods not reflected in the drawings. Drawings not yet accounted for. So who can tell us what will be the double entry for this? See whether you are understanding what Morino is doing here. What is the double entry for drawings? Drawings not yet accounted for. Drawings, which account do we debit, which account do we credit? Because remember, these are errors. That is basically what we are correcting. Which account do we debit, which account do we credit? Which account do we debit, which account do we credit? Drawings not yet accounted for. 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 Yes, so let me see what I'm told here. So we debit the drawings, we credit receivables. No. Is that the correct accounting entry? No. Can I get more trials? Remember this financial accounting. Whatever you did in financial accounting, this is basically what is being tested here. Whatever you did in financial accounting. So I'm told we debit purchases. Is that the position? No, the drawings, basically once you make the drawings, this one increases the purchases, and then you are making drawings for goods. That one will also reduce the purchases. So the drawings not yet reflected one, these will increase the drawings. These will increase the drawings. Where do we have the drawings? The drawings, we have them here. So we need to increase this. To increase this, we debit drawings. We debit drawings. We debit drawings with an amount of 450,000. And then we credit purchases. Where do we have purchases? We have purchases up here. We have purchases up here. We credit purchases. Reduce purchases here with an amount of 450. With an amount of 450. So equally here, that one will not go to the adjustment. It will equally not go to the will this go to the statement of no, because we will deduct that directly from the purchases, so that we get the net purchases. That basically what we are going to take to the statement of profit or loss, the net purchases. Okay. So then we are told additional credit losses which were omitted. These are additional bad debts which were written off. So need to have that here. So the additional credit losses. So these are additional bad debts which were written off. Now, what basically we need to do in relation to this error, one, we are going to increase the credit losses which were written off, or the bad debts which were written off, and number two, we reduce our receivables, because once we write off some bad debts, we debit the credit losses, which is in other terms as a bad debt written off account. We increase the credit losses and we credit the receivables. We credit the receivables. So when we have the credit losses, we have them here. This one is the expected, but we need to have the credit losses, this one. So we need to increase this. So to increase this, we debit. To increase this one, we debit. We debit that account, and then we credit the receivables. Where do we have the receivables? The receivables, we have them here. We credit here. Yes, like that. So we are done with that. And then we are told finally. So, and remember, you say that as far as the preparation of this 8-column worksheet is concerned, you just need to know how to deal with those particular adjustments. Because once we are dealt with those adjustments, extracting the statement of profit or loss, extracting statement of financial position, that one is quite simple. So we copy this one and we basically bring it here. We copy. Copy this one, we have it here. Okay. Let me copy that afresh. We Control C. We Control V here. So this is basically depreciation expense for the year which is understated. So depreciation for the current year which is understated basically means, I hope you can remember we already given the depreciation for the current year. This one is understated. So we need to increase it. So once a depreciation or an expense is understated, you need to correct that by increasing it. And that is an amount of 120. We increase that depreciation for the current year by basically debiting this. And then number two, this one will increase the accumulated depreciation at the end. This one will increase. So to increase this, we credit this account with 120. Credit that with one what? With 120. And I think we are done with those adjustments. So we are done with those adjustments. So what do we need to do now? What we need to do basically is remember these items will not go to the statement of profit or loss, to the adjustments, and so on. Yes, so I think we basically need to get the totals here in the adjustment column or the adjustment section, and automatically this one should automatically do what? Balance. That basically what we know. this one should also automatically balance. Whatever you have on the debit and whatever you have on the credit should be the same. Mikari is asking about depreciation. Depreciation, we have said, remember, in our case, we are told the depreciation was understated. Which depreciation was understated? It is this depreciation expense for the current year. So if this one is understated, depreciation is an expense. If it's understated, you want to increase it. So we debit this account. We debit, we record it here in the adjustment section of the debit. Then number two, this one also increases the accumulated depreciation at the start, because how do we account for depreciation for the current year? We debit the depreciation account, we credit the accumulated depreciation account. So we increase this, we increase that. Yes. So those are the two items to be adjusted. And basically, I'm saying now, once we get the totals down there, you can see they are the same. They are the same. They are the same. They are the same. So having done that now, our question becomes very, very simple. So we just need now to finalize by doing what? By preparing the statement of profit or loss, the statement of financial position. Just finalizing now. Just finalizing. Just what? Finalizing. So we start by preparing the statement of profit or loss. Actually, we can prepare these last two sections concurrently. The statement of financial position and the statement of a profit or loss. So because this is just what you need to remember. Statement of a profit or loss. So this is basically what you need to remember here. Then in the preparation of the statement of financial position, here you just need to remember that the assets, this one will be recorded on the debit side. And then the capital and liabilities. Capital and liabilities will be on the credit side. On the credit column, capital and liabilities. Liabilities will be on the credit column. I think if you can be able to remember that, then this one becomes quite simple. Quite simple. So let's just finalize this one. Let's just finalize this one. So we go back to what we have here. The first item we have is capital. Capital, this one go to the statement of financial position, basically on the credit side. Is it to be adjusted? No. Revenue, basically is an income. It will go to the statement of profit or loss and on the credit side. But I hope you can remember, you see there is an adjustment. So we will take this as this amount here, which is to be credited. Credit revenue is to add, to increase the revenue. So payables is a liability. This one go to the statement of financial position. Is it having any adjustment? No. Below that, we have the purchases return or the return inwards. We need to go back down here and we see when we record purchases return or the return inwards. Purchases return is basically what is denoted by PR. PR, you can see, is a positive. Being a positive, we have said all items which are positive, they go to the debit side. All items which are negative go to the credit side. So purchases go to the statement of profit or loss, and because it's a positive, it go to the credit side. It go to the credit side of the statement of profit or loss. Below that, we have expected credit losses. Expected credit losses, this one, number one, we take this to the income statement, the increase we take it to the income statement. I don't know whether we recorded that down here. Let me see. Expected credit losses. Yes, I think we can do this. Expected credit losses. Let's bring this figure here. This one, we bring it here. What we are going to do for this one, we will compute the total expected losses at the end of the year, and then we less that from the receivables. Yes, so let's record this amount here. Where do we have it? This one. This one, the increase, because remember this is the increase. This one we are going to recognize it as an expense. As an expense in the statement of profit or loss. The increase in expected credit losses is an expense. Then from there, this one, I'll basically use this one in computing receivables figure at the end of the year. The receivables figure. But I think the receivables figure will also be having another adjustment. Yes. So maybe first of all, we can skip that one. But basically, remember this one is not an expense, is not an asset or liability, but this one is always be adjusted in the receivables figure. So we are going to adjust that in the receivables figure. So then the discount is an expense. Discount allowed is an expense. The discount received is an okay. This one is an expense. Go to the debit side. Discount received is an income. It will go to the credit side of the statement of profit or loss. So below that we have purchases. Purchases is an expense. Statement of profit or loss on the debit side. But I hope you can see we have an adjustment here. Purchases is to be reduced. Is that the position? Yes. So that's where you can see we are crediting. So to credit purchases is to reduce. So we take this minus this. That would be the net purchases. Where do we record the sales return? As per our formula down here, the sales return. Sales return is a negative. So being a negative, it will go to the debit side. That's what you basically say. It will go to the debit side of the statement of profit or loss. Go to the debit side. Debit side here. Yes. So below that we have distribution cost is an expense. Go to the debit side. Below that we have drawings. Drawings. Where do we take drawings? Drawings, basically this one is not is what? Is not an expense. Drawings basically supposed to be deducted from capital. I hope you can be able to remember that. We left drawings from the capital. Is that the position? Yes. Drawings, basically this one we left it from what? The capital. So therefore, what we will do just like what you have said in relation to this, in relation to this expected credit losses or the allowance or the provision for doubtful debt, this one will not go here to the statement of profit or loss or the statement of financial position. This one will be adjusted in the receivables figure. The same case with this one. The same case with these drawings. These drawings, basically we are going to, this one will be adjusted in the capital. So therefore, I think what we need to do this capital figure, the figure for capital, this one need to be adjusted. Need to be adjusted. And actually we are going to adjust that with also the profit. So this figure, basically we are going to adjust it. Maybe I can just put it in red so that we remember there are two items to be adjusted here. One of it is the drawings. The drawings, because these are sole proprietorship business, and also the profit or loss. And also the profit or loss. The profit or loss. Those are basically the two items to be adjusted to that capital. Yes. So therefore you can skip those the drawings. And then this one, rent rates and insurance is an expense. It will go to the statement of profit or loss. on the debit side, but basically this one has to be adjusted. We take this and then we credit. To credit is to reduce. So we deduct this. So that is the final figure. Light heatings, heating and lighting is an expense. You can see it has an adjustment. And this is to be debited. To debit is basically to add. Yes. So then from there we have postage, stationery, and telephone is an expense. No adjustment, go to the debit side. Advertising is an expense, no adjustment, go to the debit column. Salaries and wages is an expense, no adjustment, go to the debit column of the statement of profit or loss. The credit losses, these are bad debts which were written off, is an expense. It will go to the debit side, but basically this one has to be adjusted with this particular amount we add. That would be the final figure for the bad debts which were written off. The cash in hand, this is an asset. It will go to our statement of financial position on the debit side. The cash at bank is basically an asset. Go to the statement of financial position on the debit side. The inventory at the stand, this one will go to the statement of profit or loss. And where do we record opening inventory as per our formula? Opening inventory, this one. Opening inventory is a negative. So being a negative, it will go to the debit side. It will go to the debit side of the statement of profit or loss. This one will go to the debit column of the statement of profit or loss. So below that we have receivables. The receivables, basically this is an asset. It will go to the statement of financial position. And this one has a number of adjustments. So first of all, we take the original figure. The original figure, which is this one, and then we add this. So that's why it is on the debit side. We less this amount which is on the credit side, this one. We less, and then I hope you can also be able to recall we have the expected credit losses. Expected credit losses, I said, is equivalent to the allowance for doubtful debts. So which allowance for doubtful debt do we less from the receivables figure? Is the allowance for doubtful debt at the end of the year. The allowance for doubtful debt at the end of the year basically will be equal to this one, the start, plus now the increase, this one. Or actually we less both. We less at the start and we also less what? The increase, this one. Hope you can see the receivables figure. There are a number of adjustments. There are these two errors which were made. We have one, this one should be added, this one should be deducted, and that's what basically we have done. And then we have deducted the expected credit losses at the start and also at the end. That's basically how we get the final figure for receivables. We get the final figure for receivables. And then from there, we have the property, plant, and equipment. Property, plant, and equipment, we are given that at cost. So basically, this is an asset. It will go to the statement of financial position. So where I recorded this, so this one should be here. The receivable should be here. Should be here there. Yes, because that is our statement of financial position. The debit and the debit column, it should be there. So I'm saying for this property, plant, and equipment is basically an asset. This will go to the statement of financial position. Statement of financial position is an asset on which side? The debit side. But this one will need to be adjusted with the, or actually we need to deduct the depreciation. So this will go to the debit side here, but we take the costs, and then we are going to less the depreciation. So I hope you can see this particular question. Unlike the other question which we did, we were not given the depreciation for the current year in the trial balance. But in this question, you're given the depreciation for the current year in the trial balance. It basically means that this particular accumulated depreciation we have at the end, this one, include this depreciation for the current year. So what we will do, we will take the cost minus the accumulated depreciation at the end. This one is at the end. So we will not less at the start. But I hope you can also be able to recall there was an error which was made. This depreciation for the current year was understated with 120. So therefore, we will less this, and because the depreciation for the current year was still understated, we also less this understatement. We also less this understatement because this was supposed to be more with 120. So that will give us the net book value at the end. So the accumulated depreciation, do we take this to the income statement or the statement of financial position? No. This one is adjusted in the plant and equipment. It's a net year adjustment, just like the expected credit losses. So then this depreciation for the current year, this is an expense. It will go to the statement of profit or loss. And basically, in this case, we take this plus the understatement, this one. We get the final value. And I think we are basically done with that. Let's go to these items of the adjustment. We see whether we have dealt with all. Yes, so for closing inventory, we have dealt with that. The prepaid insurance, this one will go to the balance sheet as an asset. The expense which is paid in advance is an asset. Go to the statement of financial position on the debit side. Below that, we have heating and lighting which were accrued. These are current liability. It will go to the statement of financial position on the credit side. We have the prepaid rates is an asset. You go to the statement of financial position on the debit column. And then from there we have the increase in credit losses. So this one was is an expense here. And then number two, remember it has been adjusted in what? In the receivables. I think we are done now. We are done. So I think what we need to do, two things. One, we compute the profit or loss for the year, and then from there we adjust the capital. So we adjust the capital. Let's first of all we get the profit or loss for the year. The profit or loss for the year we said should be the balancing figure in this account. So the statement of profit or loss we said will not balance. The difference should be the profit or loss for the year. The profit or loss for the year. Yes, you can see it's not balancing. The credit side is more. So we said the difference here will be the profit or loss for the year. And actually we said if credit side is more, then we have a profit. We have a profit for the year. A profit for the year. So what will be the profit for the year? The profit for the year will basically be the difference. The difference between these two totals. So this minus this one. So which will give us 22,138. So that will be the profit for the year. We record it here on the debit side. This one. Okay. That figure we must type it here manually. Let's type it manually here. It's basically 22,138 and 3 zeros like that. Yes, so you can see now our statement of financial position is doing what? Is balancing. So that is basically the profit for the year. So having this, then we need to adjust our capital here. Let's adjust this capital. So this capital will be equal to the original capital, this one, minus the drawings. The drawings, we have them here. So these drawings at the start, we also add this. We also less these drawings, which were not yet accounted for. So we have taken the capital minus the drawings at the start minus the drawings which were not accounted for. And then to this, I will also add the profit for the current year. This profit, I'll add it. So basically that now will give us the final figure for the capital. The final figure for the capital. Let's just enter. So we have the final figure for the capital, and then we do what? We balance this. We get the total. So this one should automatically balance. Let's see whether it is balancing. You can see it is automatically balancing. It is automatically balancing. It is automatically balancing. It is automatically balancing. Yes. So basically that is it, that how we do these particular questions. And if you check on the past papers, these questions are very, very common, especially that last part, the section 3, this question, you can see the other question which we did, this question which you have done, you can see there is no much difference. There is no much what? Difference, no much difference. But you can see, if you understand this, is a very, very simple question. It's a very, very simple question. It's basically a question you can be able to score all the marks. That in the position, is this question doable? Is it simple? Or is complicated? Faith. So the question here, how is this question? Kezia, Paul, Mwikari, Josephine, how is this question? Is the question doable, or is it very much complex? How is the question here? So, and remember, this is basically something you need to understand, because all what is being tested here is, one, are you in a position to prepare final accounts? Are you able to do the final, the AD adjustments? Are you able to prepare even the original trial balance? Remember, this is what you have been doing in what you did in financial accounting, whatever you did in financial reporting. And basically, as an auditor, you must be able to know how to do this. You must be able to know how to do this. Sasa, yes, Josephine is saying it's very much complicated. It's very much complicated. Kezia is asking, what if we have an audit and tax question? Which one do you select? It all depends with the question, which is simple. That's why we say we are going to basically do both audit and tax. It all depends with the questions you come across. You may come across a question in audit which is complex, or maybe simple, or you come across a tax question which is not basically doable. It is a little bit complex. So you need to prepare both audit and tax. And you always do the question which you feel you are comfortable with. Sasa, you do the question which you are comfortable with, but you need to prepare both. But I feel that this is an area which is very, very simple, provided you understand it, So, but basically I've said, like person I did accounting in high school, we used to refer to this as 10 column worksheet, because I hope you can be able to remember there is something which you are not including here, the adjusted balance. That one is not captured here. So if we include that section for the adjusted balance, we should be having 10 columns. So the 2 columns for original trial balance, 2 columns for adjustment, 2 columns for the adjusted trial balance, 2 columns for the statement of profit or loss, and 2 columns for the statement of financial position. But because we are not including that section for adjusted trial balance, that's why by the end of the day you can see we have 8 what? We have 8 column. Yes. So basically that is it, that what was required as far as this particular question is concerned. I feel that this is one of the areas you can be able to score a clean 20 marks if you happen to come across this particular question. And I hope, I know we still have other questions which test on the same. I'll be able to check the past papers. If I get one, I'll be able to share that with you, so that you do what? So that you use it as part of your revision. Sasa? Yes. So I think for today, we are going to stop at that point. So once we continue from there in our next class, we will be able to now proceed with our revision, because I think this was still part of the revision. Take into account is something we have done. So maybe the areas which you have not handled, because I don't think we have done 100% of the syllabus. So I think we are going to look on those, or we are going to cover on those areas as part of our revision. Like I've seen a number of questions in the in the past papers asking about the E function. I think maybe we are going to do something to do with that, and maybe any other area which I have not handled. Maybe we will be able to create time within our revision. But maybe once we meet in our next class, we will maybe go back to the area of financial reporting, because we say this is one of the area which is tested in section 2, which we said is the questions in section 2, we say those are compulsory questions. So we will be able basically to do a question maybe from a number of questions. We will try and see whether we can be able to do like 2 questions from the area of financial reporting. Financial reporting, remember, we did a number of items. We looked on how to prepare cash flow. We looked on how to prepare the group account, how to present the financial statement, the analysis of financial statement, the ratios, the common size, the vertical analysis, the preparation of the projected financial statements, the data visualization, and also the preparation of the dashboard. So basically what you need to do even before we meet now in our next class, can you try to revise on what we did in that area of what? Of financial reporting. So we will try to look on to revise on a number of areas. So maybe I will try to get more questions from the past papers. If I can't be able to get, I'll be able to borrow questions from a FAR. Because remember what we said is that, in fact, most of the questions which are tested from the area of financial reporting, most of them are borrowed from a FAR. From a FAR. Maybe if I'm not be able to get a good question from the past paper, I'll basically be able to borrow a question from what? From financial reporting and analysis. So therefore, for today, let's stop at that particular point. We continue from there on which day? That is on Saturday, as we continue with our revision. Equally, if maybe you have a colleague who is basically preparing to sit for August 2025 exam, you feel not well prepared, maybe you can share this information with him or her that we started our blogs today. So maybe he can be able to join us. We are just charging an amount of 2,000, and that will enable him or her to be able to access all our revision classes. So you can share that information with your colleagues who are willing basically to join us. So have a good night. Let's continue from there. 𝐎𝐍𝐋𝐈𝐍 is asking, can they test cash flow? No. Basically, if you check on the syllabus, you just need to look on how to prepare cash flow of a single company, not the group one. Not the group one. Cash flow of a single entity. Equally, that topic of group, if you check, is basically it's the basic consolidation, not the aspect you covered in AFR. It's just a simple normal consolidation. Yes. So have a good night. Let's continue from there tomorrow.